Okay, so our first speaker, this is the next speaker, but our first speaker is Jasdeep Bhogal. We know him as Jazz. I think everyone knows him as Jazz, from Shawbrook Bank, who I was thinking last night when I was looking at this, I was thinking, how long's Jazz been there? It seems like a long time, but it hasn't. It's been bloody donkey's years. And
It's been a long time.
Previously as well. How are you, Jazz? All right?
I'm really well, Tony. How you doing? You okay?
Yeah, good. So I'll crack on because I'm a little bit big. I've run over by about 3 minutes. So you've got 3 minutes to make up, Jazz. No pressure.
That's okay. No,
okay,
no
so a little bit on Jazz, folks. Actually, not before I speak about Jazz. We've sent you this morning. It's the Shawbrook Real Estate Product Guide, which is brand spanking new, I believe, just come out. A little bit on Jazz, senior regional development manager for bridging and second charges at Shawbrook Bank, and has been with Shawbrook since its inception almost 11 years ago, but has been in the financial services industry for 14 years. He previously worked for Commercial First. Those of you that have been in the industry a long while will remember Commercial First, absolutely groundbreaking within the commercial market, and did incredibly well up until the rug was pulled in 2008, I believe. And then they subsequently wiped away Laidlaw Bank, which my old friend David Johnson was very heavily involved in, and that then formed into Shawbrook back in 2012, 13? 2011 was it? Okay.
Yeah.
Blimey, it's such a long time ago. In his spare time, whilst being a father to a 13-year-old boy who's going on 21, you wait till he gets 21, he'll probably become 13 again. I've got a 33-year-old who thinks he's 9. Takes up most of his time, enjoys nothing more than going out and socialising with dinner and drinks with his family and friends. To the frustration of his wife, Jazz is very much a lover of sport and will watch anything from boxing, cricket, tennis, basketball, but particularly football. He is a huge Tottenham Hotspur fan, so he spends most weekends drowning his sorrows, quite right. And it's actually the next slide will actually links with the drowning his sorrows. Ever the optimist, he's convinced this is their year. Yeah. Okay, we'll wait and see. Okay, interesting fact. Jazz is renowned amongst his friends as being able to drink a pint of beer in less than 10 seconds, although he's not sure how proud he should be of this. I could probably do that as well, but if I was to do it, it'll probably come up in 2 seconds straight away. So I'm not going to try it. But there you go. There's his claim to fame. Pint of beer in less than 10 seconds. Jazz, it's over to you. Next slide's yours. I'll see you in about 20 minutes. Good luck.
Brilliant. Thanks, Tony. Appreciate that. Thank you very much indeed. Hi, everyone. Thanks for joining us today, and thanks, obviously, Tony, for handing over. I guess the objective today is to kind of cover off second charges with you, and the fact that I'm going first probably is good because I'll have all your attention and hopefully keep you all awake. So good morning to everyone. I'm going to kind of touch on a few bits and pieces today. I think obviously second charges and talk all things second charges as best I can, but keep it kind of as generic as possible and to the point, just in case there's some of you who are not perhaps as familiar with seconds as others. And then I guess that what we'll do is we'll cover off a little bit about Shawbrook first of all, just for anyone who doesn't know Shawbrook or hasn't had dealings with us in the past. So it'd be good for you guys just to get an indication of kind of the institution that we are and kind of where we've come from and how we've grown and where we sit today. I then will kind of cover off a little bit about the market itself. So second charge market and kind of how it's evolved over the last couple of years and the journey that we've been on with it. And then what I'll kind of do is round off the actual proposition itself. So talk a little bit about Shawbrook Bank, the products that we have, the criteria that we have, and then kind of how we can work with you guys and support your clients with regards to the second charges itself. And then I think that the best thing to do would be to cover off just a case study as well, just to give you an indication. I'll put it into kind of a live picture really, so you can kind of see just how a second charge would work. And what I've tried to do is kind of use a scenario which isn't particularly typical, just because it will give you a kind of idea of versatility and kind of what things actually can be done with a second charge. So hopefully that will all be done in and around 20 minutes. And if you guys are all still awake, I'm sure I'll be happy to answer as many questions as you've got. As Tony said, make them interesting if you want. I'll do my best to answer them, but I promise you I won't lie. So if I don't know the answer for whatever reason, and hopefully that won't be the case, then I'm more than happy to go away and find out and come back to you on them. So yeah, I guess the best place to start really is kind of the bank itself really. As kind of Tony mentioned in my intro, for those of you who don't know about Shawbrook, obviously we're a large specialist UK lending and savings bank. And we launched back in 2011, which I know probably all you guys from the intro are thinking, how is Jazz possibly that old? But I can assure you I am. I was with the bank pre-inception really. and it's been a hell of a journey. I mean, you know, to think back to when we launched, and Tony, you'll probably know this because as you mentioned, you're good friends with David as well. When we launched back in 2011, there was kind of 3 banks at desks, and you know, literally 50 of us around those 3 banks. So to see how far we've come, and kind of where we are now, it's just incredible when you think that we're kind of 2,000 people strong. And you know, the bank just continues to seem to grow from strength to strength. I think the best thing about Shawbrook, and the reason why I guess I'm still here and I love it so much, and just, you know, why I don't know, I think if you cut me open I'll bleed pink, is because the values for me just haven't changed. So as though we've grown from strength to strength, and you know, when you think about how many people work here, you know, we still seem to be grounded on the fundamentals of the business, which was, you know, those traditional banking values, you know, working with brokers and kind of really making sure that, you know, we have, you know, although we're working on technology all the time and trying to make sure that we're up to date with it to make life quicker and slicker for people going forward with the changes and becoming that fintech bank. The beauty of it is that we've always invested in people, and we've always had people at the kind of, you know, the life and soul of the business, and make sure that we've got that human judgment to make sure there's that blend between tech and actually having people around to make those decisions. Slide's probably slightly out of date now, considering kind of where we are lending wise now, but I'd say that, you know, since inception, originations have probably hit around 7 billion now, if not more. And again, that just kind of goes to show the strength of the bank, and just kind of, you know, the arms and legs that it's grown over the years. So it's brilliant to be part of this and a part of the journey. But yeah, hopefully that gives you some indication. Touching quickly on just kind of the divisions that we work in, property finance. I know that, you know, you guys are covering off a lot of this today with different areas of property-based lending. Of course, Shawbrook, you know, are active across those markets. So, you know, we very much cover development finance, bridging, buy-to-let, second charges. You know, myself, bridging and seconds is my particular forte, and then commercial investment. I think the great thing is that, you know, Shawbrook are just renowned for being kind of committed to supporting landlords, SMEs, and applicants, you know, with our property transactions. The beauty of it is, and you know, again, I keep reverting back to Tony, but Tony can vouch for it because just how long he's been with us as a partner as well. But it's fantastic. We really do recognise that brokers are, you know, the heart and soul of our business. And as much as it's all about making sure we provide the great outcome for the client, and supporting those clients, you know, there's a journey behind it, and you guys are the drivers for that. So, you know, for us, you know, brokers are very much at the heart and soul of our business, and those relationships that we have really have stood the test of time, you know, even prior to Shawbrook. So it's great for me because I can still see that those relationships are just as strong, if not stronger. And it's brilliant that we're kind of, you know, working towards making sure we continue that going forward. But we're proud of the team that we have, particularly in enterprise or property division as such. You know, it's nice that we've got, you know, the right players on the pitch in the right areas. So those with the relevant expertise for whatever it may be, whether it be commercial or you know, investment or anything like that. It's important that we have the right people doing the right things. And, you know, I'm not going to harp on about the awards that the bank have received. There's a couple of examples of just some of the lending awards that we've won over the last couple of years, but we've won many awards over the years. And it, you know, the reason why that's in my presentation is not much to kind of boast about the awards we win. It's more sort of just nice to have the accolades to kind of match the efforts that the bank have put in making sure we do everything we can to be the best we can. So yeah, it's brilliant that we're getting to where we are, and you know, the journey and the focus very much is always on improving here at Shawbrook. So hopefully that gives you guys a good indication of kind of you know, the bank itself, if you haven't heard of us or dealt with us before. So moving on to seconds, I guess the key thing for me here on seconds really is to kind of touch, I suppose, on the market itself. So if we kind of really move just kind of to the second charge market as a whole, I think it's important to kind of look back at the journey. Seconds over the years, and I've been involved with seconds for probably 9 or 10 years now. and it's always been a buoyant market. But it's probably, in truth, if you've not really been into seconds, or it's not really been your forte, I guess it's always kind of been viewed as the ugly sister almost of finance. I think since regulation kicked in, with MCD, and then obviously being regulated by the FCA, it's given it that a bit more sort of oomph, and a bit more sort of, and actually it's an important product, and actually it's a well respected product. So I think if it's not something that's in your kind of repertoire, or not something that you do a lot of, I think it's something that you absolutely need to be considering. But to look at, we'll touch on that a little bit later, but I guess to kind of look at the market, the market was buoyant. So pre-COVID, if we go back to kind of February 2020, the market was kind of unreal, as in like the biggest I'd ever seen it as a total. I mean, it grown up to about 180 million. And it's fair to say, with the lenders that we had on the pitch at the time, the competition was healthy, but there was real innovation, there was real products for everyone, and it was a really, really healthy space, and a great earner for brokers, but also a great outcome for clients. But it was crazy to think, just literally in the space of like 6 months, just how devastating an impact that COVID had on the market itself. I mean, market share dropped down to around 20 million during peak COVID. So you can only look at that and just see how much of an impact that had. It was difficult, because lenders were it was a difficult time when you think that people's circumstances were tough. Lending criteria had to be strict, because with a second charge, the risk element from a lending perspective is higher, because you're going probably at higher loan to values, you're going in behind the first charge provider. So, the risk element is there. People were on payment holidays. So the concern was that, if you're not paying your first mortgage, why are you going to take out a second? Or what impact does that have on the second charge provider? So you had the whole holiday payment issues to kind of take into consideration. And then when you think that you're looking at lending against people's main securities, and then you think that it's their income. There were so many industries that were affected income wise. So entertainment, hospitality, aviation, etc. It was a tough space. So it was no surprise that the market was hurt and impacted. But I think on a more positive light, if we look at since kind of the end of the furlough scheme, but particularly the end of lockdown, you look at the market now, and it's seen significant but steady growth. But it's brilliant to see kind of just, I looked at some figures that were released kind of in May 2022, so just a couple of months ago. And the market had kind of grown back up to around 150 million. And realistically, with the way things are going, the expectation is that it's going to continue to grow, probably like higher than what the pre-COVID levels were. So by the end of the year, which is brilliant, and really encouraging for those involved in the market, and those who are not involved in the market. I think you really need to start thinking about it, simply because, as Tony mentioned in his slides earlier, with interest rates that continue to seem to be rising, and then you couple that with the fact that a lot of individuals are probably looking at it and thinking cost of living's gone up, electricity bills, gas bills, food, just general cost of living's gone up. People are in a situation whereby interest rates have gone up. They're thinking, do I really want to go ahead and remortgage? Do I really want to go and buy a new property and increase my outgoings further, or actually am I going to stick where I am, but I've got a lot of equity available in my property? What do I want to do? Do I want to do those home improvements, or maybe because things are a little bit tighter, is it time to get that debt console, that all the debt that I have, put into one payment and reduce my outgoings? I've got the equity in the property, don't want to remortgage because I don't want to lose my interest rate, but at the same time, is a second charge the right solution? Absolutely, it's certainly something to consider. So I think now more so than ever before, it creates great opportunities, and I think it's literally going to be the reason why seconds does come to the fore over the coming months. When we look at the actual kind of products and why Shawbrook, why think of Shawbrook, look, before I kind of cover the products itself, I think Shawbrook Bank as a bank as a whole, we're a balance sheet lender. We lend our own money. As I said to you guys before, with COVID, we were really fortunate. We were in a situation where we weren't probably as restricted as other lenders. So we were able to kind of stick in the market. We restricted LTV, which was the only change we really made. But we lend our own money, so we were able to kind of be a bit more sort of flexible with the decisions we wanted to make with regards to where we restrict lending, where we kind of tighten up. And LTV wise, we came down to 75%, but we absolutely didn't pull out of any industry. So we were lending to everyone in any industry they work in, as long as they were able to demonstrate they were working there. Whereas others were like, well, retail's a no-no, and hospitality is a no-no. For us, it was kind of the opposite. If they can evidence they were there, or they were out of their mortgage holidays or anything like that, we were absolutely open to considering those applications. So we kind of stuck around. If anything, I think we were the first lender to go back up to 85%, and really listen to the market and try and support brokers in that space as well, and applicants likewise. So I think when you're thinking about Shawbrook, and of course there's other lenders out there as well, and everyone does a brilliant job, but I think when you're looking at clients who don't know much about second charges, aligning them to a bank with a reputation like ourselves, it's a feather in your cap, and it's a great tool to have. And we've seen ourselves, we saw it at the credit crunch, but also over the last couple of years, so many more brokers seem to be aligning themselves to Shawbrook just for their whole package. So whether it be seconds or whatever product it is, just because the reputation of the bank, it makes the sales process and also the client more comfortable. So it's nice that we're in that situation. We've got a little bit of an advantage there. But I mean, with the products itself, as we speak right now in the market, where with some of the recent changes that other lenders have had to make, the actual proposition is very, very competitive. So when you're kind of talking, variable rates starting from 4.2%, lending at anything from 5k to 500,000, I think the flexibility that second charge gives you, with repayment periods of kind of 3 to 30 years, and being able to take applicants up to the age of kind of 85, when you think that the average lifespan of a second charge is kind of generally 3-4 years, having that flexibility to reduce those payments, it gives clients the opportunity to take their equity, keep it affordable, and then when they are in a position where generally what they tend to do is refinance, it's a great option. We have a specific large loan product which is really, really working well at the moment. As I said to you guys before, when you think people have lots of equity, they're thinking about staying where they are, maybe doing that extension that they've been putting off, or maybe redecorating the house, or getting the garden done because they know they're going to be sticking around. When you think about the fact that they're combining that with debt console, the large loan product is really working well. So it's a limited edition product that we have at the moment, but it's 5-year fixed, which sits at 4.55% a month. And it's for loans over £100,000, capped at 75%. I think that the key driver here is we have two variable 2 and 5-year fixed, but a real unique selling position for us is that we don't actually have any ERCs on any of our products. So, even if they take out a fixed rate and then it's a 5-year fix, but in 3 years' time they're in a position where they want to redeem, they're not going to get hit with early redemption charges and heavy penalties there either. So, the product itself, certainly with regards to rate, etc., but actually just looking at it from outside the box, when you couple it with the lender that you're talking about as well, I think is very, very attractive. The fact that we can go up to 85% loan to value as well, of course, it's always good. Moving on to loan purpose, let's be honest, anyone who does actually do second charges, you'll probably know that the majority of scenarios that you get when it comes to second charges are going to be debt console, home improvements, but they are typical and they are kind of standard uses. A lot of people may approach brokers discussing an unsecured loan, perhaps, where they just want some money, and then when you go through the advice process, it could be a case of, okay, well, actually, you've got certain levels of debt that have you considered consolidating that, and then before you know it, it's gone from a 10 grand loan to 30 grand loan because of the options that are available with regards to reducing outgoings by consolidating everything together. So that does generally tend to be the main two purposes, but I'll touch on a couple. I mean, I'm not going to read them all off, but I'll touch on a couple of these that I think are quite interesting. Business purposes is an interesting one, because I'm not suggesting new startups, but we're quite flexible with our self-employed employment criteria, and how long they have to be self-employed, which is 12 months. So, when you think that someone wants to inject some money into the business, when you base it on just a year's worth of income potentially, but you can see that the business has traded well, and you understand the business purpose of what is it they're actually looking to do. They're just looking to kind of invest in the business for a specific reason. As long as you can get comfortable with it, then absolutely. As long as it's a new startup, then we'll be more than happy to see if we can support that need. Deposit for additional purposes of a property is an interesting one. We can use the second charge as a deposit, and then all you'd need to kind of obtain would be literally a DIP to show that the remainder of the funds are covered with the other lender for the buy-to-let mortgage. Or it could be that you want to get sales particulars and you want to evidence the fact that the second charge is being used to purchase the additional property outright, and that's going to be an investment property. Again, absolutely, it's something we can consider. And we won't take the additional payments into consideration for affordability or anything either. So there's some good tweaks there with the criteria whereby, if you're looking for that flexibility and you're thinking, okay, people may not want to buy a new house to live in at the moment, but they might want to buy an investment property. You could use your equity in your current property in order to do that way. Repaying a tax bill is an interesting one. Of course, you need to understand the circumstances and why they haven't perhaps paid their tax. Don't get me wrong, if you can see that someone's a serial borrower and every April they come to us and get a second charge or go to different lenders to get second charges, then it may twig. But, under the current circumstances, people's outgoings have gone up. People might be in a situation where emergency repairs to their home would come up and they use the money that they put away for their tax to actually have to use that for another purpose, and that's why they're coming to us. Absolutely, we'll support applicants with repaying tax bills. Lease extensions is an interesting one, so we can use it for lease extensions. School fees is becoming more and more common. And then obviously you've got scenarios like transfer of equity where they're divorce cases, or even repaying a help to buy scheme. So the reason why I touched on some of those loan purposes there is because again, whilst I appreciate that the majority of those scenarios generally tend to be debt console or home improvements, a second charge is a lot more than just a debt console deal. So it's worth bearing that in mind. And when it's any legal purpose, you've got a team of experts you can contact, so you can, speak to myself or speak to the internal sales team, or, go to Tony, absolutely, and go through him. But the key here that we're trying to say is that, don't just be blind or tunnel vision with what a second charge is, and actually, really, really look at it as in like, this is a great opportunity for you guys to be diversifying your business, and what you guys do. Why work with Shawbrook? Some of the USPs, I guess, for us, when it comes to couple with the kind of loan purposes, etc., is the fact that we don't have a minimum income. So your key case on with Shawbrook, we work mainly off the kind of household composition and the income that you put in. As long as it fits that, then there is no kind of minimum income requirements. I mentioned kind of the limited edition large loan product already. But kind of we'll look at scenarios where people have historic credit issues. The system and the portal is actually a really important thing to mention. I mentioned technology earlier. The portal is brilliant because it takes you on a journey, which is literally from dip stage all the way through to completion. But it's really quite intuitive. So when you key it on, what it'll do is it'll run the AVM, it'll do the credit searches for the clients. It will do the AVMs. So technically, or potentially, if a case fits on an AVM, then the applicant doesn't need evaluation. It runs land registries as well as credit searches. So actually, at the end of it, produces a needs list or requirements that that will cover off someone's packaging requirements day one. And we've worked really hard on the system of late to make sure that the day one needs list is actually as accurate as it can be with regards to what the underwriter would ask for day one. So flight times are really down at the moment because this is reflecting really well, and then that really helps from me not having you to have to go back to your client all the time and ask for more information from a day one update. So the portal is brilliant. We look at referrals for cases that are outside of criteria, and that can be done by the portal as well. AVMs, as I said, is a huge thing. We've probably got one of the market leading AVM propositions whereby applicants can borrow up to £300,000 at 65% loan to value. They can have £100,000 at 75% loan to value, and even 50 grand at 85. So the flexibility on AVMs is brilliant because it stops that whole need for evaluation. Minimum time in employment, I mentioned self-employment is 12 months. Minimum time in employment is 3 months. Again, when you look at most lenders, the requirement for them to have applicants been in a job is 6 months. We'll absolutely consider 3 months. So that's actually standard criteria. Downsizing is an interesting one as a kind of USP. When you think that, how lending into retirement, most people want to have evidence of a pension. We'll actually consider downsize as a viable kind of exit for the second charge mortgage itself. So, if what we can even do it, the way we work it out due diligence wise is you look at their current equity position and you go, okay, well, based on the current scenario, this is how much equity they've got. If you kind of look on Rightmove and you kind of look around and you kind of see that what they could purchase even in current climate today, based on that equity, it gives them options. And you think, okay, well, fair enough. In the future, they're probably likely to have more equity. So, you can make a judgment based on that. And that gives us the comfort to be able to consider downsizing as a genuine exit. LTI is at 6 times. Minimum property value is a good one at 70k, which I think is always useful, particularly when you think you lend around the country. There may be areas that don't have property values at such a high. When you're able to be as flexible as we can at 70k without restricting loan to values, again, that always helps. And we have the expert team, which is obviously we've got the internal sales team. You've got myself, and you've got Tony and the guys. But we also have no ELTs on any of our products. So as I mentioned before, it's a really, really good USP, to be honest. So I think the key thing here is from a broker perspective, if you don't consider second charges, just like out of the credit crunch and just like out of kind of COVID, I've seen a lot of people looking to diversify and come into the market and work with us on that side of things. Finally, I'll just touch on a case study. I know I'm probably pushed for time. This will give you an indication of kind of how flexible things can be. We were approached by one of our long-term brokers with a second charge inquiry that they had. The client was looking to raise an urgent £500,000, and it was a different scenario. Basically, they had a plot of land right next to their security, which was about to be purchased for commercial purposes. Now, that would clearly have had quite an impact on their property value to a detrimental effect. So the applicant was really concerned, and they wanted to purchase that land themselves just to kind of retain the property value that they have at the moment, and not have that impacted. So there would have been some kind of conveyancing issues with regards to land registry and kind of getting that all resolved. But we worked very hard with our conveyancers and with the clients. The clients were very, very quick and supported the broker in getting documentation back as quickly as possible. And to give you an indication of speed, we were able to kind of complete that and fund it from the date it was submitted. We funded it within 7 days. So it gives you a real indication of just how quickly second charges can work. And again, that's not a standard debt console deal. That's a kind of a different scenario. So it gives you an idea of the kind of flexibility as well. So I'm hoping that kind of wraps it up mainly. Tony, I'll kind of hand over to you. I don't know whether that's
Jazz, thank you. Marvellous. I thought that was absolutely excellent. I really did. One of the best second charge presentations I've seen in a long time. So well done. It really was good. We've got a few questions. I will just say one thing. Some of you might have heard of a forum called Cherry, which is for IFAs, mortgage brokers, and I'm a member of it. We do a little bit of advertising on there, and I'm a member of it. And I just flag up anything that relates to second charge. And I saw a very, very disturbing chat very recently. It was asking about second charges and who was the best at this moment in time. And the amount of people on there who say, well, at the moment, I just give all my business to Precise. I don't bother with second charges or second charge brokers. I just give it all to Precise. Precise at the time, their rates were 2.5% above the market norm. Now, that is not right for your client. So if you're doing that sort of thing, then see it, because Precise aren't really in the market for second charge. They don't really want second charge business. So they are so uncompetitive. It is just, they're just not in the ball game at all. So if second charges is something that you do, second charges is something I've been doing for almost 40 years now. If it's something that you do on a small basis, there are lenders out there where you could be getting a much better deal for your client. As of yesterday, Shawbrook have all of a sudden become the cheapest in the market. So expect a rate rise from Shawbrook at any moment, because they're offering 4.2. I don't know of anybody with a rate card at the moment that's offering anything under 5%. And that was as of yesterday about 5 o'clock. So if you've got anything sitting on your desk at the moment, bung it over to us, because it's not going to be there for long. Get it while get it whilst it's still there, because it will be gone very, very soon. I can't stress that enough. I really can't. We've got a couple of questions. We are a little bit behind time, but we'll catch up, no doubt. So Ketan has just asked regarding second charge mortgage on a buy-to-let. Shawbrook don't do second charge on buy-to-let, Ketan, but there are products out there. I've made a note to speak to you later, if that's okay, because our products out there, they're not fantastically competitive at 85% because there's not a lot of lenders doing it, but they are out there. Where are we? So there's Francis asked, how could a second charge work with Shawbrook if the lender with the first charge does not accept a second charge? Now, Jazz can probably answer this to his Shawbrook extent. I can then answer that to the broker with a wider panel extent. So, Jazz, you answer it first.
Yeah, I think the difficulty is if the first charge provider is not going to provide consent, then there's not a great deal you can do, because obviously we have to physically register the charge at land registry, and then because there's restrictions on the land registry title itself, land registry won't actually register that charge without the consent of the first charge provider. Now, I know Tony's probably thinking about equitable charges or different ways in which you can do that. Perhaps we wouldn't be able to support that ourselves, but I don't know, Tony. That might be one for you from a different perspective. We'd struggle possibly.
Currently, since second charges became regulated by the FCA, the same as first charges, we always had a situation where consent was required quite simply because it was such a great profit centre for lenders. Halifax, for example, were getting something like 200-300 consent requests a day, and they were charging at the time anything up to £25-50 for those. So you imagine how much profit they were making on those. You've got the likes of NatWest, Lloyds, RBS charging £100 at the moment. They never ever refuse consent.
I've got to say that, yeah, I agree. I can't remember the last time. I can't remember the last time in even 6 or 7 years that I've seen a lender decline consent, to be honest.
Yep, exactly the same. Kensington will not give consent if there are any arrears in the last 12 months or any current arrears or any payments missed in the last 12 months. They're the only one I know of that actually causes any problems at all.
The thing is, though, I guess to a certain extent, Tony, that would make the client ineligible for a product with us anyway. So, if they've got arrears on the mortgage, then you're kind of stuck anyway.
Hot off the press, there is now, because under treating customers fairly and whatever the FCA has decided to call their latest reincarnation, which goes further than treating customers fairly, there is now a campaign been started by yours truly to have restrictions removed altogether on residential property, so that clients can actually do with their property what they wish and not be beholden to the first charge lender. I mean, there was a situation years ago that some first charge lenders only put a restriction on land registry so that they could then, if they got a consent request, they could go to the client direct. That's the reason why they were doing it. Others were doing it because it made them a load of money. I am now campaigning, and I've got Amy involved and others involved, where we are trying now to ensure that customers cannot be refused consent. The other thing is that we're not going to be charged for it. Charged for something that literally takes seconds, because consent is now causing lots of problems. Land Registry have come out with so many different requirements when it comes to consent. It has to have a wet signature, it has to have the name of the person who signed it, it has to have their job title. It can't be electronically signed unless you've got an arrangement with Land Registry beforehand, and most haven't. So it's now nationwide, for example, have started removing all restrictions purely because they don't want the aggravation of having to give consent, because they weren't charging for it. And it was just taking up too much of their time for their staff. So it will change. It will definitely change. I've got two more questions. Ketan has said LTI is 6 times. Is there a minimum income to get that LTI, or is it any particular profession?
No, absolutely not. So as I said, with us, we basically work our affordability off a automated model. So we use M&S statistics. And the key thing for us is you guys at your end inputting the income and the household composition correctly. Once you run that against the affordability model, if it fits, then absolutely they're able to get as much as they can possibly out of the deal. There's no restriction with regards to industries they work in or kind of what they do for a living or anything like that at all. I mean, you can, if it's, even if the property's worth 70,000, for example, and if it fits and they can get up to 6 times on their income, then no problem at all.
Okay, one more question. Dharmesh has just asked, I have a retired couple on state pension, but on a mortgage at 35% LTV. Can they add their son on the mortgage who is self-employed and raise 100,000 for home improvements as a second charge? I know what Jazz is going to say.
Yeah, so look, if it was, unfortunately they can't, because 2 is the maximum number of applicants that we allow on the application at present. So it wouldn't work with us. If you'd asked us that question about 5 years ago, that would have been absolutely fine, no problem at all. So yeah, unfortunately the answer is no. But it's there may be lenders out there where you could probably do that, to be fair.
Okay, Dharmesh, it can be done. through other lenders, but, and there's a big but here, we have to ensure that it's not a situation where the son is trying to get money out of a property that his parents own so that he can go and take it down the casino or something of that nature. So there are a lot of hurdles to get over on a deal like that.
The other concern we used to have on those as well was you have to look at the kind of you get a due diligence on what happens if tomorrow the son decides to move out. How do the applicants then, the parents then afford that mortgage? And that would always be a question that comes up, just as a heads up.
Yep, absolutely. Jazz, absolutely fantastic. Thank you very much. We will be inviting you back. I shouldn't think you're going to get any bad marks today. If you do,
I hope not.
I'll be having a word with the delegate in question. But,
I hope not.
That seriously was one of the best presentations I've seen in a long, long time. So
brilliant. Thanks a lot, Tony. Really appreciate it. It's an absolute
problem
pleasure.
at all. Jazz, we'll see you again. I will move on very quickly.
Have a fantastic day. Cheers, guys.
Yes, Simon will remove you, Jazz, from the meeting. Don't close yourself down. You might have to close down the entire thing. All right. So
I'll wait to be closed down.
All right,
Thank you.
Simon, close Jazz down, please. So our next speaker is from Hope Capital. Today's sponsors is Charlie Gregory. The last time Charlie presented at one of our shows, I did say that I've got socks older than he is. Well, that is actually true, but I did find a pair of socks in my drawer the other day. Probably they're older than everybody who's presenting at today's show, because there's a pair of ski socks that go back to 1982. So I was going to bring them in, but I forgot. So Charlie, I can hear you, so I presume you can hear us loud and clear. Good. We are a bit behind time, so I'm relying on you to bring it back for me, if you would. So There's a picture of Charlie. No, it's not. It's a picture of the criteria. All you have been sent this today, so check your email for this. Check the spam if you haven't received it, because it has been sent to everybody. So Charlie's business development manager at Hope Capital, focus on providing brokers and their clients with fast, bespoke bridging loans. Charlie began his journey in specialist lending at an estate agency, but more recently has worked for both bridging and buy-to-let lenders. Charlie already has well-established relationship with brokers, which have enabled him to help many clients achieve their goals. And Charlie's interesting fact, he was born in Paris, then spent 8 years living in Japan. Unfortunately, he can't speak any Japanese. I don't know, you communicated when you was over there then. He can't speak any Japanese, and we will let him off speak in French as he left there when he was just 6 months old. So he's going to do today's presentation in English, you'll be pleased to hear. I hope. I hope. But Charlie, over to you. As I say, you've got a little bit of time to catch up if you can. If you do go over time, I'm going to be glaring at you on screen. So
no pressure.
Over to you.
No pressure. Yeah, thanks, Tony, and thanks everyone for obviously listening to me today. As Tony mentioned, started my career as an estate agent a little while ago, then working for a specialist buy-to-let lender, and then most recently a couple of bridging lenders. So currently working at Hope Capital, company based in Liverpool, who offer short-term bridging finance. I'm the BDM who covers London and the South area, although we've got legs on the grounds all over the country. So, as I mentioned, Hope Capital, based up in Liverpool, unregulated short-term bridging lender. We lend against residential property, mixed-use property, commercial property, and also land. I'll go into these in a little bit more detail on my next slide, but we have refurbishment range, we have development exit ranges, we have a fast track bridge, we have a finish and exit bridge, and we also have the Scottish collection also. So just to go into those in a little bit more detail then and give you a little bit of a flavour for what we're about, we lend 50k minimum loan size up to about 5 million maximum, and that's over a 3 to 18 month term. So it's all short-term lending. Being in Liverpool, we understand that there is also a market for the lower property values. So 50,000 minimum loan size is quite competitive in the space that we're in. Obviously, we wouldn't want to fill the books completely with £50,000 loan sizes, but we're okay to go to those sorts of levels. As I say, up to about 5 million. We can always consider more than that on a case-by-case basis. So I've put there straightforward bridging. So that's just pure bridging, no element of refurb at all for that. And that might be that there's a chain break, or a lot of the time when you go to auction, sometimes the assets are in good condition, but they exchange there and then, and they've got 28 days to complete. So a lot of the time your long-term finance is just not going to be able to complete in time. So straightforward bridging. We also can do conversions, heavy refurb, light and cosmetic refurb. So that's our refurbishment product. So that can be your light tart and turn. Again, taking an auction purchase as an example. A lot of the time they're not in lettable conditions. So sometimes, or a lot of the time, they need to go in there, purchase the property, refurbish it to a lettable standard in order for them to then sell it at a higher level or put it onto a buy-to-let mortgage with one of your mainstream lenders. That's your light and cosmetic refurb, but we also do heavy refurb, which also includes conversions. So a lot of the time we see commercial units being purchased and then converting them to residential flats. It could be a residential house being converted to 2 flats. We've seen quite a few semi-commercial assets where the configuration is a commercial on the ground floor, and then it's just one big flat above. Sometimes they want to make that 2 flats above just to optimize their earning potential on the rental. We've got 100% build costs covered. So we obviously have LTV restrictions. The only times it doesn't really work on the LTV restrictions is where the client has potentially not got the best deal and their end value is not that strong. But we can cover 100% of those build costs in arrears for the clients to help them with the refurbishment. So we've also got finishing off wind and watertight properties. So this one is a little bit like our refurb product, but that might be a developer's built 3 houses, the structure's all up, the windows all intact, but inside it's a complete shell. They run out of funding. They need to rewire the property. They need to do all the heating. They need to do the flooring, absolutely everything inside. So we're more than happy to step in and give them money to effectively finish off these projects. Going on from that, we've got developer exits. So that's pretty much your finished unit. So taking a development of 3 houses as my example, practical completion, building reg sign off, all of the 3 units are finished, but maybe they've run out of time on their current facility. So we're able to come in, give them a like-for-like refinance, just giving them some breathing space to sell the assets and, again, optimize the profits and sell them for their true market value rather than having to reduce that to repay their current lender on time. So borrowers can be UK nationals, foreign nationals, or they can be unique company structures. So again, although bridging sometimes is looked at for asset-based lending, we also look at the individual, and if they're a quirkier individual living abroad, foreign national living abroad, we're okay to look to lend to them as well. So just to touch on max LTV, so our maximum loan to values on residential properties, we've got quite a competitive LTV up to 80%. Commercial assets, we're able to go up to 65% LTV, semi-commercials up to 70%. And then we also lend against land up to 65% LTV. So where I mentioned we can do refurb and conversions, whether it's light, medium or heavy, we can also lend against land, although we currently aren't in the ground up development space. So a lot of the time with land, it will be acquisitions. We've seen some where clients have got option agreements to buy land at 200,000, let's say. They've then achieved planning on that land, which then has increased the value to, say, 600,000. We're okay then to go in and fund 100% effectively of the purchase price of the land for the acquisition. And a lot of the time with exits like that, it might be that they want to do development finance themselves, or it might be that they then just want to sell that on at the higher value to a different developer who's looking to undergo that project. So obviously with those LTVs, they're all a gross figure. So the net figure will be a lot less, which will go into the client's back pocket. We have got flexible different payment strategies. So what we can do is your standard retained interest where the client's not spending anything per month. We can do rolled interest, which is where the interest is compounded monthly. We can also do service interest. So servicing, obviously, where you're paying the interest monthly. gets you a much higher net loan. But obviously it does come with a monthly payment, which sometimes can look or appear to be quite high. So there is a little bit of due diligence from our side to make sure that the client can effectively afford that payment. We are also now lending in Scotland as well as England and Wales. So again, a good selling point. There's not a huge amount of lenders in Scotland in that market. So again, if you get something in Scotland, we can help. It is a slightly different process there with the laws and the whole sort of buying and selling process. But we're comfortable to help your clients with their projects there. So in the top right there, I've just wanted to touch base on the need for speed. A lot of the time with bridging, you look at bridging because it's the speed element that clients need, or they need the flexibility. But I would say probably those are maybe the main two: speed, flexibility, because the asset's not in great condition. So if they are in need for speed, we'll take the generic example of going to auction. Maybe they've exchanged there and then, and they've got the 28 days to complete. We can look to do AVMs up to 70% LTV. So an AVM is obviously a lot quicker. We can do desktop valuations up to 75% LTV if they need a little bit higher gearing on the LTV. We can do full title insurance. So again, title insurance, I'm not sure if you've come across, but that's on the legal side of things. It's a little bit like no search indemnity. But it basically just ensures that solicitors are not waiting for searches, and they're not waiting for lots of things that can be very time costly. So full title insurance just enables solicitors to work very quickly and get a deal done a lot quicker than what they would be if they were doing the full legal process. We can also consider no PGs up to probably a maximum of 60% LTV. No PGs is a funny one. 99.9 times out of 100, a PG will never be used. You know, the interest is secured against the asset that we've put a charge against. But I can appreciate from brokers' perspective, some clients are sometimes not keen to offer a personal guarantee. So there's ways around that, and we can be flexible with it. You know, we can cap it obviously to the amount of our advance, or in certain scenarios we can just not insist on having one full stop. No upfront legal undertaking. So again, that's a really useful thing for a client, just keeping their costs down day one. You know, it's always, I guess with clients, a lot of the time they're quite keen to get things done, and then once they start having to give over money, that's sometimes where you then start getting delays and they start having doubts or whatever it might be. So having a no upfront legal undertaking can really help just sort of bring those costs down day one from the client. So dual representation as well. This is a massive selling point for us. We have only recently done this or introduced this, and we've started to see some deals complete. So we've got a company called Gunnar Cook LLP who are based in London. We know one of the partners there very well, and he's partnered with us to do to act for us as well as the client. So one, that makes it a lot quicker, and two, it's a lot more cost efficient. Most of the delays that we have from bridging transactions are unfortunately due to the client solicitors. Not all the time, but a lot of the time they sometimes are conveyancers by trade, and they just don't understand the process of bridging and the need for speed aspect that it holds. So having the dual representation from a firm that knows how to deal with bridging finance can be really helpful, and it's a lot quicker. So I didn't want to go into the ins and outs of all of our rates, but recently we have been trying to, or we have relaunched all of our rates to make them a little bit more competitive. Now I know rates aren't the only thing, and sometimes they're not necessarily important at all. It's whether or not a lender can deliver, whether or not a lender can be flexible with some criteria, or get a deal done in time for a client before they lose a property. So a higher rate is not always an issue, but I do understand sometimes you get clients that say go with the cheapest rate, or they're very much rate driven. So residential bridging, our rates now start at 0.59%, and that's the same for our refurbishment rates as well. Again, that's up to a maximum LTV of 80%. Mixed use bridging, these rates start at 0.78%, and that's the same for our refurbishment on mixed use as well. They start at 0.78. Commercial bridging 0.78, and commercial refurb also 0.78. Land with planning, so our rates start at 0.79%, and we've got their max LTVs of 65% as well. So as I mentioned, land with planning is ideally just for the acquisitions as opposed to the build, but we're quite happy to go up to sort of 65%, which is quite strong on the gearing, so that can be quite popular. Development exit, which is obviously what I mentioned before, where the assets are completely finished. Those rates start at 0.69%, and we can go up to 80% LTV for those as well. So I just wanted to include a couple of case studies here, because I completely appreciate that everyone talks a talk, and a lot of the time the proof is, well, the proof is always in the pudding, so to speak. So in this scenario here, Fast Bridge delivered to secure a sale of a desirable investment property. Our facility was just over £86,000 gross over a 12-month term, about 66% LTV. So in this scenario, the client was looking to purchase a 2-bed detached property in South Wales. The seller was already in a chain, meaning that they were looking to sell the property as soon as possible. Our clients were also aware that there were other interested parties for this property. They were eager to secure the funds within 3 weeks so they could proceed with the purchase and the chain remain intact. So this is quite an interesting case study here. And I remember actually, what we're finding at the moment is, and I'm sure you guys will agree with me, the market is incredibly buoyant and it's still very, very hot. So we found that we've come across clients who are looking to purchase properties, and now they might not be the only interested people in that property. So, you know, if they're in this scenario, if the vendor selling the asset has got a chain in front of them, and they have 2 buyers approach them, one buyer with an offer of 300,000, but they have 4 people behind them in a chain, or another buyer at 285, 290, but they've got a bridging loan agreement in principle ready to go, so effectively looked at as cash. Sometimes your clients can actually achieve a slightly lower asking price because they're available and they're ready to complete on that property transaction within 3 weeks. And sometimes with these scenarios, the process has already started on the vendor's onward purchase, so they're all okay from a legal perspective, so they're sometimes playing catch up. So yeah, we were able to secure those funds for the client within 3 weeks for them to purchase a property. Happy broker, happy client. Another case study here for us to discuss. So this one was a commercial refurbishment, which would make for a great investment property. So the facility amount was £1,068,000. The loan time was over 12 months, and the LTV was at 60%. So this particular client was looking to secure a relatively large bridging loan to fund the purchase of an unused 3-story commercial property, which they were keen to invest in as a commercial refurbishment project. So this also just gives you a flavour as well of what bridging loans sort of enable you to do. It just gives you a bit of breathing space to purchase a property. Now, this client, I remember they didn't necessarily know whether they wanted to keep the commercial asset as commercial, maybe conduct a light refurbishment on the property and rent out the commercial as serviced offices, or whether or not they wanted to go down the route of permitted development or planning to actually look to convert said security into residential flats. That's something to touch base on that we're seeing a lot of at the moment: commercial refurbishments or conversions to residential flats. There were some changes with planning, which meant that commercial assets didn't need full planning for conversion to residential assets. They can now look to do that under permitted development, which just means for a developer it's a lot less risk, and it can be a lot cheaper. So we were able to complete on this purchase for them, and they're now just deciding what they want to do moving forward with the property. So I've got a last case study here. Sorry if you can't see that too clearly, but so we deliver a refinance solution to achieve a HMO investment. So the facility amount was just over 320,000 over a 12-month term at 50% LTV. So we were approached by a client who's basically looking to obtain a new bridging loan as their existing loan with another lender was reaching the end of its term. So this particular property, which was a mid-terraced house based in London, had very good space and had already been transformed into a HMO property. So this was quite an unfortunate situation for the client because they had a bridging loan facility with a previous lender that I would presume they took out for the acquisition and the conversion to a HMO. They were actually in the process of refinancing this HMO with a long-term lender when it was taking a lot longer than they had expected, and the term unfortunately had got to the end of its term with this bridging finance lender, and they weren't keen to extend the term any further. So this client came to us basically quite desperate to refinance the property away from the bridging lender and just give them some extra breathing space to then secure long-term finance and not lose their property. Which was a really nice asset, HMO. The rental yield was fantastic. Obviously, we all know what London prices are like. So on a room-by-room basis, it offered fantastic investment opportunity. It was just unfortunate with the timings for the client. But yeah, we were able to secure them a bridging finance, a rebridge from a different lender, give them some breathing space, and now they're carrying on with their exit, which is the long-term finance. So just going to touch base quickly on the end-to-end process with us at Hope Capital, because every lender is slightly different. So the initial inquiry is received by one of the sales team. If that's an inquiry that we can look to do, if that's an inquiry that meets criteria, we can just look to issue an agreement in principle along with an application form directly to yourself. If the client's then happy with the agreement in principle, they'll fully sign the application form and sign it and return it to us. This application pack is then sent over to the underwriting team for them to start their process. So underwriters will then complete the formal terms. They'll get valuation quotes. They'll do all their due diligence, so their soft footprint credit search, Google searches, all of that sort of stuff. If the client's then happy to proceed, they'll sign the formal terms and return them to the underwriter. They'll pick the valuer of their choice that they want to use, and we'll look to instruct them. So we receive the loan terms back, we receive the valuation back. Subject to that all being okay, the solicitors will be instructed. Depending on what the deal is, an asset manager will be instructed. And then the legal work will start commencing. So once the legal work is all commenced and everything's okay, hopefully with full title insurance, so it's nice and quick, we'll then fund the initial loan. I think I've just got one more, Tony. So
That's it.
Any questions?
You got any questions? Charlie, thank you very much. You got no questions. Oh, you do. Dharmesh immediately pops out that question. Foreign nationals, company structures, what are the requirements?
Cool. So with foreign nationals and expats, requirements are that we just require them to have some sort of bank account or credit trace in the UK currently. So a lot of the time we'd maybe look at one UK asset. The other requirements are pretty much quite standard as a standard criteria. Company structures is, again, similar. We can look at even lending to trusts, but we just need to understand the exact sort of setup as what that trust is, who's involved, and we just need to understand the deal fully, and then we can get comfortable with it. Then we're okay to lend effectively. Okay,
Jamie has said well delivered, Charlie, and my apologies. I should also say well delivered. It's very well delivered. I just got distracted by an immediate question popping up. So
no worries.
Well done, Charlie. We do have one more. Dharmesh has just said thanks. Okay, so a couple of questions you set yourself, Charlie. So no pressure on getting these right.
Yeah,
I'm sure you will. What's the difference between AVMs and desktops?
Yeah, so this is a question I get asked a lot, and sometimes people call AVMs desktop. So our difference between the two would be an AVM is a system called Home Track, which basically we go in and we just type all the information into it, and it gives us an instant result on valuation. Now that costs something like £35, which we pay for, so the client effectively gets a free valuation. Desktops are slightly different, so we can there's two ways to do them. We've got VAS and Method on our books. They can either go to all of their panel firms and ask them to provide desktop quotes and turnaround times, but a lot of the time they can be incredibly time consuming, or they can be effectively the same time and price as what a full valuation would be. So we've got a company called VAS Audit within the VAS team who will provide the desktop quote for us at very reasonable costs and return it within 48 hours. So it's not as quick, and there is a slight cost for the client, but that's the difference between the two.
Okay, excellent. And last question, always love asking bridging lenders this. How quickly can you truly complete on a deal?
Yes, and I think that's a really important question, because every BDM and every bridging lender will just say the best, we're the quickest in the whole world. And you have to really sort of dissect it a little bit, because there's a lot of things within the deal that will determine how quickly it will proceed. Does it meet the AVM criteria and desktop criteria? Can we do full title insurance? Is it a refurb facility where it's heavy and we need to get a QS report? Because, that can take a little bit longer. Who are the clients using? If we're using dual representation, then there's no excuse to say that it's the client solicitor slowing things down. So it can be a lot of different things. And a lot of the time we need the broker pulling out all the stops as well. So if we're requesting documents, then, so this is on Specialist Hub now. If we're requesting documents from you guys, we need them back, as quickly as possible. So if all of those things work quickly and there's no sort of hiccups, we're geared to complete on deals within sort of 2 to 3 weeks. But it is quite important that it meets a lot of those things that I sort of discussed, and everyone is working to that same time scale.
I cannot stress enough, delegates, how important it is, if you're not heavily involved in the bridging side of things, that choosing the right partner for the bridging deal and someone that knows what they're doing is absolutely vital. Because there's a lot of bridging lenders out there. I mean, for every bridging lender that comes to us now, I actually send them, you're probably all aware that when you apply for a lender agency, you have to fill out a form. Well, bridging lenders now, when they come to us, they have to fill out a form that I send to them. And so I know exactly how they work. And 9 out of 10 don't even reach our panel because they're not fit for purpose. It may be how they actually raise their funding, for example. I'm not happy with that. It might be from just one very wealthy individual who could pull the plug at any moment. So it's just ensuring that we've got a bridging lender that's going to be around and can actually do what they say. Because every bridging lender that comes to, if I say to them, what's your USP? And they say, we're really fast, then the conversation's over, because it's a stupid thing to say. So choosing the right partner right from the outset is very important. And then that partner knowing which lender to go to, having the knowledge that if a deal has to be completed in 2 weeks, there's no point going to the lenders that offer 0.4%, because they're going to want as much information as they would on a buy-to-let mortgage. And it's just never going to happen. So choosing the right one, absolutely vital. Choosing the wrong one, and there's a few problems at the moment within the bridging market with some of the peer-to-peer lenders. I'm not saying all of them, but just some of them. If you choose one of those lenders and that deal goes through, you will lose your client, because your client will never, ever use you again to raise finance for him, because that lender will absolutely, I don't want to say rape and pillage because it's two horrible words, but the financial equivalent. I've had 2 clients in the last 18 months who have had to pay £100,000 plus. And these are not for big bridging deals, 100 grand plus, because they went slightly over term during COVID. When the FCA instructed lenders to be obviously fair with their customers. And these 2 particular companies were anything but fair. So again, one of the things I'm trying to do at the moment is to just educate people as to who they should be using. It's very, very important. Very important. We have one more question, and we'll have to stop because otherwise we're going to be running so late. We'll be doing this at 2 o'clock, and I've got a meeting at 2. So Paul has asked, hi Paul, hope you're well. Will you accept a challenge on an automated valuation?
That's a good question. Unfortunately, we don't have the capacity to challenge the system. But something that I have done in the past, because with the automated system home track, it takes like an average sometimes. So again, it needs to really be a standard residential asset. But sometimes if you've got a road where you've got quite different assets down there, you've got 1-bed house, 3-bed house, then you've got some flats. Sometimes the value might not come back exactly where we expected it to be. So we can't challenge the automated system, but what we are able to do is then look to do a desktop, because with the desktop, there's actually someone behind the screen looking at the asset, taking into consideration the size, the asset type. And I've had that before where an AVM came back at, let's say, 280 and we needed 320, and we had a desktop done and it came back at 320. So then we were okay to move on with the desktop. So I guess that does help sort of challenging the automated valuation.
Probably the only way you can do it, because you can't really challenge a computer.
No.
The computer
robot, yeah.
As we all know. Right, Charlie, thank you very much. Simon will remove you from the room. You can still stay if you want to and watch everyone else, but yeah, Simon will take you out so you don't close the entire thing down. Thanks once again. We'll see you soon. Come and visit us. Right, everyone, what we'll do is we'll come back at, I almost pressed the wrong button there. We'll come back at 11:30. That just gives me time to pop to the loo and get myself another glass of water. We'll see you then for our next speaker. Okay, everyone, we'll crack on. Just gone 11:30. I don't know if you've been looking at the news, but there's been lots happening this morning. Journalists all going crazy, trying to justify their income. But we won't cover that. That's not what we're here for today. So we're going to go straight on to our next speaker, who's just appeared on screen. Grace, can you hear us?
Yes, can you hear me?
All good. All well?
Yes, really well, thank you. How are you?
Yeah, good. Grace is in our top 5 of BDMs for every lender we deal with, because she's one of the most efficient we've ever come across. So I do say it every time, just so that she keeps remaining efficient with our stuff. So because she knows how much we actually appreciate what she does. I will crack on. We are a little bit behind time today. So Grace, we're not going to stand the ceremony. So we're going to immediately go on to our next speaker. As you see there, picture of Grace, a little bit more up close. Family Building Society, great lender to have on board. If you've not come across the Family Building Society before, and you're in the residential market, then this is something that really is going to be well worth listening to. So as you can see, there's nothing normal about the Family Building Society, just from the marketing material alone. That's where it starts. So, but you've all received that by email. What you haven't received is that we actually have 2 product guides that are our own product guides, Family Building Society. Unfortunately, I've just come back from holiday and I update them, and I haven't had a chance to do so yet. I wasn't doing last night, but I was still writing slides at 11:30. So I hadn't had a chance, but they will be done probably tomorrow, because I'm at an awards do tonight, which I don't want to go to. But anyway, that's another thing. Grace has been working in the financial services industry for 5 years. Hobbies include socializing, traveling to new places, and binge watching the latest thriller series on Netflix. I've actually run out of stuff on Netflix now, which is, as you can imagine, takes up quite a bit of her free time. She also loves meeting new people, which is why she enjoys her job so much. Interesting fact, Grace has completed a skydive over the Palm Jumeirah in Dubai. Most amazing experience of her life. As I've said before, I get dizzy just standing at the top of the stairs. So I will never, ever do that.
You know what the funny thing is? So do I. I don't like heights, but the opportunity is there and I've got to do it.
Absolutely no way at all. If I see something on the telly, my stomach starts to go and I can't watch it. So Grace, straight over to you. I will see you in about 20 minutes.
Amazing. Thanks, Tony. Thanks for the introduction. Hi, everyone. I hope you're well. So yes, Family Building Society. If you haven't heard of us before, you may know of National County Building Society. So anyone that's been in the industry for some time, you may know of us as national counties. But I'll go on to that in a little bit. What I wanted to cover today, so I'll give you an insight on who Family Building Society are. I'll also touch base on our semi-exclusive rates that Specialist Finance have got access to as well, if we have enough time. As Tony said, he'll get them sent out as well in the upcoming days. And then I'll also touch base on our general criteria and USPs, and then our areas of lending. And then if we've got the time, any questions, feel free to ask away. So who are Family Building Society? As I mentioned, anyone that's been in this industry for some time may know us as National Counties Building Society. We rebranded to Family, it must have been December 2016. And the reason for the rebrand is we wanted a name that would really fit into the target audience that we were trying to approach and the lending that we were trying to achieve. So we do a lot of intergenerational lending, hence being the Family Building Society. And as you can see there, we lend to first-time buyers, being 18, to applicants into their 90s. And we look at different clients at all different stages of their lives as well, whether that be for expats going to live and work overseas for a period of time, or those that are just looking to build on their buy-to-let portfolio as well. We look at those very generously. So our key areas, I would say by far, our biggest area of lending is the later life piece. That's where we see majority of our business come from, especially over the last few years, even since we was national counties. National counties is very traditional in the way that we lend, but we've still had that flexible approach. And when we did change it over to family building society, we thought, how can we push that even further? How can we become even more flexible and sort of be that go-to lender for these type of clients? So I'll go into the later life lending piece in a lot more detail shortly. But our other key areas is the fact that we don't credit score as well. So all of our cases are assessed on a credit search, and we use Equifax as our credit reference agency. Now, as you can see there as well, we have flexible underwriting approach and be able to make those individual decisions. So with the fact that we base everything on a credit score, of course, some clients might have the odd blip here and there in their credit report. We understand that as a lender, we're all human beings here, and you've actually got a human being sitting at the end of your mortgage application. So we know that some blips may happen, admin error, or they just don't realise. It's only really the bigger areas of adverse that we tend to want to avoid. And that's the defaults and CCJs above £500. We would typically say, can that be satisfied for 3 years before they're able to consider looking at it? However, sort of moving on to that individual underwriting approach, and to give you an example of how we really do maintain that mindset is, and surrounding the adverse piece as well, I had a case a few months ago, and the client had a default on a water bill. You know what utility companies are like. They put them on for fun most of the time. But this client specifically had a £700 default. It was registered to an old address, so they hadn't realised it was on there, and they found out when they started looking for this mortgage. Cleared it straight away. They had really good income, no other issues on their credit report, and it was a really good loan to value. So the quality of the case was brilliant. It was someone we should be lending to. And what I was able to do is I was able to speak to one of our underwriting managers and really sell that case, highlight the reasons why we should be lending to this client, but identify where we're falling outside of policy here. And the underwriting manager was more than happy to consider that case for us because it made sense. We could understand that this wasn't the client's fault, and the overall case itself meant that we was able to consider that as an exception. And we do that a lot as a lender. If you came to us, if you came through specialist finance and the team in the office thought, this is something that family might be able to do, they can pick up the phone to me and I'll do the AIP at the outset, applying that common sense approach and think, how can we get this to fit? If we do then need to refer it on to an underwriter, as soon as they've given their stamp of approval against it, that's then going to support your mortgage application throughout to completion. Don't have to worry about the computer says no policy with us. It doesn't exist at Family Building Society. And so you're actually then able to challenge things as well if sort of at underwriting stage, the underwriter is a bit concerned about something. You can either pick up the phone to myself or send an email to the underwriter and actually explain it and gives that information to them directly. So as I mentioned, the later life piece is a big area of lending for us. It's where we see majority of our business come from, and that's because our stance is so flexible. Now, we do offer a Rio product. If I'm going to be completely honest, we don't see a huge amount of business come from that particular product because our stance on a standard residential interest-only mortgage is far better. So here you can see that we lend to age 95 on a repayment mortgage. And I'll go on to the interest-only criteria on the slide after this. But the type of cases that we're seeing from these clients are those that are on their mortgage with the high street lender. They've come to the end of the term. They don't want to downsize from the family home, and they don't want to remortgage onto an equity release product. So they come to us because we're able to act as that alternative lender for them and give them another option. Now, you might be thinking, Grace, that's all well and good, you can go to age 95 on a repayment mortgage, but how the hell is my client going to be able to show affordability on that basis? Now, we will take earned income to age 75, and that will be typically someone that isn't in a really manual role. So in a non-manual role that would allow them to work to age 75. We might be able to push that a little bit further to age 80 with referral to an underwriter, depending, again, what that client does. So that's very much on a case-by-case basis. But any term beyond that is when we're going to be looking at their projected retirement income. So you've got your typical state and your private pensions. We'll use 100% of those, nice and easy. But we want to look at the more quirkier income streams. So what we'll do is we'll look at pension pots and investments. And I've given the example of an investment ISA, i.e. stocks and shares ISA there. Really, any investment that is invested here in the UK and it's a sterling-based investment, the underwriters will be happy to consider that as an income for us. And what we do is we take 80% of that most recent valuation and divide it by the term. Now, what's great about that is the clients do not have to be drawing from it at all. You know, they could be working for as long as they possibly can and then eventually draw on those investments. It's entirely up to them. As long as they are of an age and in a position to draw from it if we need them to, then that's income that we can take. So yeah, 80% divided by the term. To give you an example, someone had £500,000 invested. 80% of that is 400,000 divided by a 10-year term, say, keep it simple. That's £40,000 worth of income that we can use to support that affordability without them having to draw from it. So what we're seeing a lot more at the moment are limited company directors who have built up a well-established company. It might even be a family-run business, you know, son and daughter have come in, they really have got that control over that management structure there. But, you know, the parents are still working because they love it and they'll work until they physically can't anymore. Now, this is actual income we can take. What we will need to see is the accountant just write up a reference letter, really, really simple, just confirming that our clients have got that management structure in place that would allow them to take a step back from the company at any time. As long as they can confirm that, then we'll use that over the maximum term available to them. And then lastly is rental and investment income that's declared on their SA302s. We just need 1 year's figures. We don't need any more than that. And, you know, whilst I mentioned all of these incomes that can be used into retirement, if you've had someone that has got a guaranteed income and it can be evidence that it's guaranteed into retirement, let's speak to an underwriter and see what we're happy to accept for them on that basis. Now, interest-only lending. I love our interest-only product because I think it's great. It's so flexible and it's available for different clients. We see it a lot more for those older borrowers as well. So maximum age on an interest-only mortgage for us is age 89, and we will offer a 5-year term to an 89-year-old. So it is based on term guidelines. So for example, a 70-year-old at the point of application, we would initially offer a 16-year term to them. However, at the age of 86, we can potentially extend that term by a further 6 years for them. So they're still getting that extra long term, and that's why, alternatively to the Rio, people go onto this product instead, because you don't have to worry about that pre-deceased assessment. You've still got that long term available to them, and you can use the different sources of income as well to support the affordability. Now, with all of our residential mortgages at the moment, we are looking at a maximum loan to value of 80%. We could actually go up to 80% loan to value on an interest-only mortgage, and that will be where they've got an alternative repayment strategy in place. So, for example, they might have second homes, buy-to-let properties, even those investments that we don't need to use all of it for affordability, say, an element of that could be used as their repayment strategy as well. So with all those things, mix and match as well, we can go up to 80% loan to value. But most typically, people have got their main residence as their only asset. So we'll be more than happy to accept downsizing as a suitable repayment strategy. Now, the only criteria to this is that it's maximum 70% loan to value, with the possibility that they can comfortably downsize, ideally within a 5-mile radius. Now, all the underwriters do in that instance, they go on to Zoopla or Rightmove, they put in the property postcode, filter it down to 5 miles, say, and put in the remaining equity. As long as they see 3 or more listed properties, then they'll sign it off as a repayment strategy. And it's as easy as that. Now, you might be thinking 5 miles, it's not a massive radius for them to find another property. And I would agree with you that in that instance, if we are struggling to find 3 properties, could we maybe push out to 10-mile radius instead? The mindset behind keeping it within a close radius is we don't want to have to rely on someone moving so far away just to be able to find somewhere to comfortably live. So you could also then look at putting in the limit a bit on repayment as well, giving them more equity to downsize with at the end of the term. We have no minimum income, no minimum property value or minimum equity with our downsizing criteria either. It's just that we have to see that they're able to do that. Now we're looking at the affordability, and Specialist Finance have got access to fixed rates as well. One of those being a 5-year fixed rate. Now, when looking at the affordability and the term, say, would be over 10 years, the calculator will stress it as a repayment mortgage. Now, this is when the bouncing ideas of one another comes into play. So you could either say, should we reduce the term down to 10 years? That will then allow us to stress it on a pure interest-only calculation. It's not going to make any difference to the affordability payments, given it's an interest-only mortgage. Or rather than doing that, could we put it on a 5-year fixed rate that Specialist Finance have got access to? All of those things factor in affordability and increasing that borrowing for the client. Now, self-employed applicants, again, I think we've got a really great stance on this, especially at the moment, given COVID and how much impact it had on self-employed clients in a lot of industries. You need a lender that's going to take a common sense mindset here, which is what we'll do. So we'll typically ask for 2 years accounts in any case, though 1 year may be acceptable with the right type of client that has been in the right kind of industry where they've been able to maybe build up a client bank, for example, or they've been really high earners previously in an employed role. That might be the type of thing where we take 1 year's account for. Though when sort of applying a common sense approach for those clients that have been affected by COVID, what we're typically doing at the moment is having a look at the figures prior to lockdown and those most recent figures as well. And if they're of a similar level, we just completely ignore the COVID year, because it's not fair for us to do that. If we're having to factor in the COVID year for something that is not the client's fault, they had no control over, it wouldn't be fair and it wouldn't be common sense lending in our eyes. So that's why we really want to look at the bigger picture there and see what kind of position the clients were in beforehand and since. Now, all of our self-employed applicants, the income that we will take is their director's salary and their share of net profit. It has been noted that they'll need to have more than 33% share in the business, though underwriters are typically happy to work from net profit where they've got less, so we don't have to work from them as a PAYE applicant. So these are a couple of case studies, which I think are always useful to read, so you actually get a real life scenario of how we've been able to help these clients. So Mr. and Mrs. A, they had a successful care home business, run it for 20 plus years, very, very successful. They didn't have much day-to-day runnings in the business since their children came in and looked after that business on their behalf. So when they came to us, they were in the early 80s, and they had an interest-only mortgage outstanding with a high street lender. Didn't want to move on to an equity release product like most people do at the moment, but they still had a good shareholding in the company and were still receiving an income into retirement for them. So what we were then able to do is offer the 9-year, keeping it on interest only, and been able to offer them that £350,000 mortgage for them using their self-employed income into retirement. All we needed in this instance is the accountant's reference to confirm that their children looked after the company for them and that they had taken that step back from the day-to-day runnings. And then the second case study, again, an older client who wanted to utilise his SIP and his investment income. So he owned his main residence that was unencumbered and wanted to release the equity to gift the money to his son. So it falls under that family assisted bracket as well here, where we're seeing them capital raise for gifting purposes. So then what we was able to do was use the income from his buy-to-let portfolio and also use 80% of his pension pot as well. And then he was able to gift that £200,000 to his son to be able to buy his first property. So there are just a couple of case studies there. Now, moving on to the family assisted products that we've got two in particular. One certainly more popular than the other, which is the joint mortgage sole owner product. We see so much business again come from this area of lending, and that's because of the terms that we're able to offer the parents. So whilst this is designed for those clients that have got the deposit but not enough income, it means parents can then come onto the mortgage, but they're not on the title deeds, there's no additional stamp duty fees for them, but still being able to offer them that longer term because we go to age 95 on this particular product. What we'll do is assess it on the parents' projected retirement income if they're not yet retired, but we'll use all of those incomes I mentioned on earlier. Now, we have no set minimum income for this particular product. We ideally want someone to be earning in and around £20,000. So it's not set in stone. If you've got someone that has just gone self-employed and they've only got 1 year's figures, again, that is the type of scenario that we're able to help with as well. And this can also work the alternative way. So rather than just parents helping children, children can also go onto the mortgage with their parents as well. If they're struggling to justify the affordability into retirement, kids can go on there for a short term, being able to keep them in the family home as well. So we've got a family mortgage here. I'm not going to go into loads of detail about it purely because of time, and also because there are other lenders out there on the market that are able to offer a 90 or 95% product without the need of additional security like we do. Ours is very similar to the Barclays Springboard product if anyone's familiar with it. But in this instance, we're looking at 95% borrowing. Now, this is designed for those clients that have got the income to support the loan, but just not enough deposit, hence the need of additional security. We'll take the maximum 20% of the purchase price and either put that in charge of savings or a charge on the family member's main residence. Now, this doesn't have to be a first charge. We'll go as a second charge. We've even gone as a third charge as well on some cases. Now, the real reason why I wanted to mention this product and why I see anyone using it is to utilise the offset facility. So whilst I say this is designed for those clients that can afford it on their own, there may be an instance where they fall short by £20,000, £30,000 saying, you know what the market's like at the moment, you have to move quick, otherwise you'll lose the property. They don't have any more deposit to put down, and family members don't want to gift this money away because they'll never see it again. Now, with the offset facility, it allows family members to offset up to a third of the loan amount, which not only offsets the interest on their monthly mortgage payments, but it's also offsetting the amount we need to assess them for affordability, making it a little bit more flexible there for them and should really give them the borrow that they need in that instance. And then this is just a standard, residential and buy-to-let offset product that we've got, very different to the family mortgage offset, just like the typical one that you would see from most lenders. Now, on a residential basis, it is a repayment-only product, but on a buy-to-let basis, it is available on interest only. Now, they can offset up to 100% of the loan amount, and it is an easy access account as well. So if they needed the money, it will be in their account the following day. I think it's especially great on a buy-to-let perspective. Not many lenders offer a buy-to-let offset product, and the fact that it is available on interest only, and if they put 100% in, they won't be making any mortgage payments at all, is brilliant. You're going to get a far better return than any other savings account on the market at the moment. This is available in both ways. They can either offset the interest on the mortgage or they can offset the term. It's available on both options. Now, our mortgages for expats. Again, a big area of lending for us because our stance is again, very standard. It's like your standard residential product and your standard buy-to-let product as well. So there's about 45 different countries in total, Australia being one of them, and I've listed a few others: South Africa, Hong Kong, America, and then Europe. Middle East is still on there. It has unfortunately just been taken off, sadly, which is really annoying. Hopefully it will come back on. For a long time we did offer mortgages to expats living in the Middle East, but only about a week ago it was taken off. So then our calculations for our expat mortgages is the exact same. It doesn't ever change, and it's the same for high rate taxpayers compared to portfolio landlords. It's always going to be the same rental calculation that's applied. The only time it changes is if you're looking at like-for-like borrowing compared to capital raising and purchase. And Specialist Finance have also got access to the 5-year fixed rate as well. Sometimes we may need to put that 5-year fixed rate on there. That will then get you the borrowing that you need. Now, in terms of how we would treat an expat, sometimes there's around some confusion with this. It needs to be a UK resident holding a UK passport, living and working in one of our acceptable countries. Now, if you're looking at it on a residential basis for an expat, how we'd look to consider it is where they're buying a property here in the UK, where it's going to be their base. As long as they've got the correct insurance policy in place, we're happy to lend on a residential basis. And we're also happy to accept home currency income as well. Now, that will be where it's employed or retired income. Self-employed we can't quite look at, purely because we don't understand their accountancy procedure over there, and we're not familiar. It's all going to be in a foreign language, and it's going to be very difficult to translate. So typically employed or retired income to support the residential expat mortgages. On a buy-to-let basis, we ideally want them to have a UK mortgage in place, but again, that's not set in stone. As long as they've got that UK bank account, that's all that we're looking for here. And then lastly, our buy-to-let lending, just across the board standard, which is maximum 70% loan to value at the moment. It's something we're really working on changing, but it's sort of been placed on hold for the moment. But we'll see. Fingers crossed, we can go up to at least 75% soon. First-time landlords accepted where they are an owner-occupier. If they're not, could we maybe put a parent on there that is an owner-occupier? I had a limited company one the other day. Son was first-time buyer, first-time landlord. He had decent income. Having mum on there who was an owner-occupier, our head of underwriting was happy to consider that for us. No minimum income at all. All we ask is that clients are able to cover 3 months mortgage payments if there was a rental void. And we really favour portfolio landlords. So there's no maximum number of properties that must be held in their portfolio, and we don't stress the portfolio in the background either. As long as it's self-supporting and we can see a copy of their portfolio schedule, that's all that we want to see. And then we also offer a limited company buy-to-let product as well. No personal guarantees are required, maximum 60%. Doesn't have to be a brand new SPV, can be existing as long as it was set up at the outset with those recognised SIC codes, and up to 8 directors and shareholders allowed. And that's it from me.
Grace, thank you very much. Wonderful. We got a couple of questions. I've got Derek has asked. He asked this right at the start. Actually, he's asked: Are your mortgage offers only valid for 3 months?
No, typically they will be valid for 6 months, depending on the product. So products at the moment that have just been released, they're valid until the 1st of October. So it does vary, but typically we try and keep the offers valid for as long as possible, but sometimes it's dependent on the product itself and what expiry date that's got.
Okay. Paul was asked: husband owner occupier for a first-time landlord not owning a residential.
So you could probably look at a joint borrower sub-proprietor mortgage on that instance. We've done that a lot in the past, where husband and wife, one of them is going to be on the title deeds, and then the other one on the mortgage. Yeah, that's the type of thing that we would look at, even though that they are not a first-time buyer and not first-time landlord, not owning a residential.
The questions you set yourself, we've actually changed because they relate to buy-to-let.
Okay,
so there's been a bit of a situation this morning in that I uploaded the wrong presentation. So my team in the background have just uploaded the right one. That's why it's actually about residential mortgages and not buy-to-let. So my team has actually set you a couple of questions. What's your maximum LTI?
LTI,
Yeah,
loan
loan
to
to
income.
income. Yeah.
Loan to income. We don't have a specific loan to income ratio, if I'm honest. Very much case by case, because everything's assessed on affordability. If you're ever looking at sort of like a debt to income ratio as well, again, very much case by case. We don't have anything that's set in stone.
Okay, my team knew that. They just wanted to ask the question so you could answer it because it's such a positive answer. And will you use retained profit for self-employed?
Won't use retained profit, no, but we will use share of net profit.
Fine, good, excellent.
Yeah.
It's just about to go 12 o'clock. Grace, thank you very much indeed.
No worries, thank you for having me. Thanks
You've done your 30 minutes, so you've done 29 actually, so that's great. I'll talk to you very soon. I'll get the Family Building Society rate cards out to you. I'll try and do it tomorrow, as long as I haven't got too much of a heavy head.
Amazing. Thanks so much, Tony. Thanks everyone for your time. Have a lovely day. Bye.
Bye-bye. So our next speaker, we got Gary Maher from Castle Trust Bank. I met Gary for the first time about 3-4 weeks ago. Lovely fella, and also had numerous conversations with him, as you'll probably find out when I do my bit at the end of this. So, and you'll find out the reasons why. You've all received this today. This was hot off the press on Monday. There he is. Gary, you okay? Can hear us? I think your mic's off. Gary, your mic's off.
Sorted.
Yeah,
I've failed on the IT skills already.
Yeah,
but,
that's okay.
Good afternoon, all.
You move a little bit closer because you're a little bit closer because you're so far away. It makes you look like you're about 19 feet tall. That's better, right? That's good. Right,
Not quite 19 feet.
No, not quite. He's not far off though. Okay, so you should all receive that by email this morning. Gary has predominantly operated in the finance sector throughout his career to date. Before joining Castle Trust Bank, he worked as a business manager in a BMW dealership for 8 years. In the 12 months that he's been with Castle Trust, he has gained promotion from telephone business development manager to business development manager. Now, his interesting fact, I've edited Gary, to be honest with you, because for a very, very good reason. So, interesting fact, in one season, Gary successfully managed to watch his team, which is Manchester United, beaten in the last ever game at White Hart Lane versus Spurs, and get soundly thrashed at the last ever game at Upton Park versus West Ham. That's because I've been a West Ham supporter since October 1968. And I don't think I was at that game, but I know I watched it. But I was a season ticket holder for many years at West Ham. So
I usually deliberately try and keep that vague, Tony, in terms of the team. But no, outed from the very beginning.
Absolutely. So that now means that all of our deals will be at the bottom of the pile when it comes to Gary rather than top. That's not the case at all. Gary, we'll crack on straight away. We are a little bit behind schedule today. So there you go. All over to you. I'll see you in 20 minutes.
Thank you very much. Well, as I said, good afternoon, everyone. I'm going to take some time to talk you through our term offering, just to highlight some key hotspots. So essentially, by the end of our time this afternoon, what we want to do, importantly, is create an understanding for you guys as to where Castle Trust sits in the marketplace, to understand, excuse me, what we can do, and obviously, importantly, what we can't. I think everyone is time, everyone is short of time. So if we know we've got that understanding of what we can't do, ultimately, as brokers, you have clients to service at the end of everything, and obviously we want to make sure that we are coming back to them as swiftly as possible. Again, to highlight some key hotspots of where we're seeing a lot of success at the moment, and just essentially to flag Castle Trust as an option, obviously for yourselves as brokers, and ultimately for your clients operating obviously in that buy-to-let space. But again, to offer some different options for you and your clients. So just to make sure that you are aware that Castle Trust are there and are a viable option for your clients. So we do, we'll touch on this very swiftly. I know we're going to focus on the buy-to-let part, but we do offer specialist short-term lending. In terms of who we lend to, this is similar across the board. So we do lend to foreign nationals and expats. I think historically we've kind of hung our hat on that area. We do very much still consider foreign nationals and expats as potential borrowers. Portfolio landlords and first-time landlords are certainly considered. We consider first-time buyers as well, as long as they are purchasing with or in a limited company or SPV. We can certainly consider first-time buyers. We don't have, and this sort of ties in quite nicely with the first-time buyer piece, we don't have a minimum income requirement. Now, what we do want to see is evidence of an income, but we don't have a monetary value on that. So as I said, it ties in quite nicely when looking at first-time buyers, that they may not have that 40,000 whatever sort of level of income, but we can still consider them as long as they have something. In the buy-to-let space, obviously, who we consider, and this would be a bit of a theme for Castle Trust, in that it really is sort of one for all. So all types of clients and all types of security would potentially fit on our term products. We have a term product, but not a holiday let product by a multi-unit block HMO product. It's the one-term product which we will impose on all the various different types of securities. Now we do, as you can see on the left-hand side here, holiday lets, we certainly consider multi-unit blocks, various sizes, which we'll touch on shortly. HMOs, see an awful lot of success. Then we have obviously larger portfolios and usually standard buy-to-let properties, all considered. So some key points to our criteria. As I've mentioned, all products are available to all types of customers. So our term product, which in a second we're going to give a bit more detail into what our offering is, which is, as everyone I'm sure will agree, sort of a ever-changing marketplace at the moment. But we have cut with something which we feel is able to give brokers and obviously in turn their clients a little bit of security and confidence that we're going to be able to offer what we say we are. So as I mentioned, first-time buyers and landlords and investors are all accepted. Foreign nationals and expats. With foreign nationals, if it's a foreign national outside of the EU or EEA, we would require a minimum lend of £500,000. Outside of that, if it's a UK national within the EU, the minimum lend is £200,000. We lend on residential property only. So any semi-commercial or commercial properties would not be for us currently. So when they say residential, it is very much the investment side of residential. So we're looking at buy-to-lets, holiday lets, HMOs, etc. Main residence would not be for us. Obviously, that would fall into the regulated space, which we're not currently involved in. We lend against securities in England and Wales only. So not to to say that there's anything wrong with the securities in Scotland or Northern Ireland. I think the rules to charges and whatnot are a little different and overly complicated compared to England and Wales. So it's not something that we currently consider. So Northern Ireland and Scotland would be a no, but England and Wales very much so. We can offer dual rep legals for any lends up to £2 million. So with that, as long as the solicitors have 2 SRA accredited managers operating in the office that they have chosen, that they operate out of, sorry. As long as they have those 2 SRA accredited managers, then we will be good to move forward using the dual rep for those solicitors. We have a minimum size requirement for properties. I have a slide in a second where we touch on multi-unit freehold blocks, where it becomes more important. Essentially, we need an average of 35 square meters. I mentioned, and it is just contradicting myself there, minimum loan size of 100,000. That is actually 200,000 now. So just to, as I mentioned at the offset there, just to highlight some key areas and hotspots of success for us. Holiday lets has been a massive. We've seen a massive boom in inquiries. It's been by far our busiest sort of product. When I say product, it is still our standard buy-to-let product that we'll be looking at there. With holiday lets, we lend on the holiday let income, so not the standard AST. What we would ask to see is two sort of independent valuations from the likes of Sykes Cottages or cottages.com. They will give us an indication of the high, medium, and low expected sort of take ups, and what they would suggest the weekly income would be. We take an average of that, and they would usually give us a number of weeks that they would expect the security to be available for as well. Quite simply, we'd multiply that up. When comparing that income to a standard AST, so obviously it's usually considerably higher, and obviously will then have an impact on the amount that we could potentially lend. Limited companies, we can do holiday lets for limited companies or individuals, so limited company will still be considered. And first-time investors, first-time buyers, we would also consider for holiday lets, following the same rules that they must be purchasing in a limited company or SPV. Residential properties only. So that with regards to holiday lets, where that comes into play is that there must be, although we will be lending on holiday let income, there must be a owner-occupied demand for the property, and the property must be without restrictions. So if the property, for example, can only be used as timeshare, or if there is covenants in place that it can only be used as a holiday let or second home, that would prevent us from being able to use the security to lend against. It must be free of any restrictions at all. As again is a theme throughout, expats and foreign nationals are considered. It really is, and just to reiterate, it's one product for all types of client and all types of security. One question we always ask brokers to answer is just, does the security, and we're looking at it as a holiday let, does it pass the sniff test of would you go on holiday there? So typically what we would expect to see is the location to be in a typical holiday let destination. So that's pretty much all of the south coast, into Cornwall, Devon, Norfolk Broads, that sort of area. For some reason, pretty much all of Wales seems to be designated as a holiday let or holiday destination. Obviously, you've got the Brecon Beacons and that sort of thing there. So all we're saying is, if you have you're trying to get a case to us and it's a holiday let in Slough, not to cast any aspersions to anyone who lives in or is from Slough, but I don't think that would be on top of many people's list as a holiday destination, so it's probably not going to fit. So multi-unit freehold blocks. Again, this is another area where we're seeing increased levels of cases coming into us. So multi-unit freehold blocks, and particularly development exits, where a development has been put into place and the developer is deciding, as they often do, I want to keep some, I want to get rid of some units, are often very undecided, but this is where we can potentially help. Now, just to give you a bit of a flavour for the size of units or size of blocks that we will consider, we've recently completed on a case that had 4 units in a multi-unit block. We've also, previous to that, fairly recent times, completed on a deal for a 67-unit multi-unit freehold block. So it's quite a vast difference there. So there's certainly different ends of the scale in terms of size. Now, we do, as a bank, we are, I think we benefit from quite a flat structure in terms of trying to speak to, or having to speak to the decision makers. We can do fairly swiftly. So we try and be as agile as we possibly can. And if we need to if we're looking at a case, for example, of 67 units, we might have had to think outside of the box in terms of maybe a bespoke valuation, or, as I mentioned, I did say I was going to come on to the unit sizes. So we require an overall average of 35 square metres. And we've mentioned on there that there's a minimum size requirement of 30 square meters. So as long as that average is 35, if we're being completely honest, if we have a 67 unit block that we completed on, there were a fair few units in there that were maybe 27, 28 or 29 square meters. But in terms of lending criteria, you have to draw the line somewhere. But it's just an example of that agility where we have to try speak to the right people to get comfortable and maybe think sort of outside of the box to make that happen, and maybe come up with a bespoke valuation. We would use aggregate value on blocks of that up to 20 units. But if we have to think outside of the box and come up with something in a bespoke nature, then we certainly will do. There is certainly willing there to do whatever we can to become comfortable with cases. Now we have a maximum loan, and this again is across the board of 15 million. It'd be 15 million with sort of board approval, but we go up to 10 million quite comfortably. But at the moment, and there's I'll touch on this in particular with the changes to it's like specifics of rates, etc., with regards to our term offering. So some takeaways from today's session, obviously with regards holiday lets, multi-unit freehold blocks, HMOs, first-time buy-in customers or first-time landlords, expats and foreign nationals, what we certainly want to do is make sure that Castle Trust are on your radar, that there is an offering that we have that we feel is fairly robust and is there to assist your clients. And make their obviously purchases and refinances, etc., make that happen. But what I just wanted to touch on in closing is that with our term product, so we have, I think it's fair to say we have it's a fairly streamlined product offering anyway, but even more so in the current climate and how we've tried to sort of react to the market conditions to try and offer some security to brokers and ultimately their clients. So what we have with our term product, our term offering, essentially it's a 5-year fixed, 5-year ERC product at 4.96%. That is the rates. Now that is currently, and to say that is that going to go up maybe after July or August when we're expecting some further raises, it's likely that it will do. But what we are saying is that when we produce terms on our buy-to-let product, we will ask, and this is going back to our MD, a gentleman named Barry Searle, who's been in the industry for quite some time. He has decided that we'll go back to the 90s, where this sort of there's a rising rate environment back then. And what he used to do, and wherever he was working at the time, was would take a booking fee, which would guarantee the rate for a finite period of time for the case to be completed. So with our term business, we will ask for an upfront fee of 0.07% of the lend. Now, once that is paid, that guarantees that rate for a period of 120 days from the time that terms are generated. So essentially, we have 120 days to work together to get the case completed. If we go past the 120 days, then we need to look at obviously repricing again. But what we are able to say is that on payment of that booking fee, that rate is guaranteed. So it's not going to be pulled and increased as long as we're working within the time frames. So 120 days essentially gives us 4 months from issuing the terms, get everything going, get valuations done, and it's obviously what we want to do is obviously provide as good a service as possible to make sure that we're both winning and those cases are moving through the pipeline in a timely fashion, and we're getting those rates that we have decided or had locked in. But from here, so you come to the end of the presentation there. But of course, happy to answer any questions at all.
Gary, first of all, thank you very much indeed. I missed a little bit of it because I had to pop to the loo, so I'm hoping that Rory's question hasn't been asked and answered, so I'll come to that in a minute. But that pretty much covered everything. And there is some stuff I'm going to be talking about with Castle Trust, as Gary will probably expect after the week we've had with Castle Trust, that I'm going to be talking about a little bit later. So stay tuned for that, purely because that is the most difficult case I've ever dealt with that I mentioned earlier on, or two of them actually. But that's coming. So we've got one question from Rory, which is, Gary, will Castle Trust fund on a term basis a 10-bed hotel bed and breakfast with one kitchen as a holiday let? The use class today is C3, not C1. So I presume former hotel bed and breakfast now being used purely as a holiday let with 10 bedrooms.
What is important is C3. So we need our securities to be C3 or above. So C4 would be going into like sui generis, HMO sort of thing. But if we have confirmation that it is of C3 usage class, then yes, we can certainly consider that.
And Rory, I'm booked to talk to you at 2 o'clock today, so we can obviously discuss a little bit further at that stage. But that looks like that could be a goer. Someone else is typing, but I'll ask one of your questions, Gary, that you set yourself. Do you lend on properties with a flat roof?
We do. However, we do have an upper boundary of the total surface of the roof. We can look up to 50% of the property can be up to 50% flat roof. Anything above 50%, then no, it wouldn't be for us. But we can consider properties with up to 50% of flat roof.
Okay, next question is, do you lend on an investment value or for HMOs greater than 6 rooms or 6 tenants?
We lend on a bricks and mortar valuation for HMOs. So it's always bricks and mortar.
Okay, and finally, someone else typing now, do you lend on undervalue transactions?
We don't. We lend on, essentially we were looking at is purchase price. So if they have bought at a reduced value, say if the client has bought at a reduced value, we'd be looking to lend on the amount that they have purchased the security for. Obviously, if they've purchased it some time ago or bought it under value and they've done some works to the property and can evidence that, then that gives some rationale behind why we should be looking at a higher value, then we can certainly consider that. But what I will say is, with lending criteria, you have to publish sort of very black and white. If we need to have some conversations to get comfortable with particular securities and scenarios, then we can do that on a bespoke sort of basis.
Okay. Somebody was typing, but it doesn't appear to have gone through. Someone's now typing again. So I'll see if there's anything else I can ask you. How are Castle Trust managing the testing rising environment? That's your words.
Well, yeah, they just touched on it there in terms of we're trying to provide some security to brokers and their clients by being able to commit to, that's for a period of 120 days, but on payment of the booking fee, essentially that product, as long as the case completes within 120 days, the broker and then obviously then the client can have some security of knowing that rate is what they've got. It's locked in. The only reason that we would need to reprice it is if we go past that 120 days. We feel 4 months is adequate, touch wood, to get the case in, and get it through the pipeline. That's certainly what our intention would be. Okay,
it does keep coming up that someone's typing, but it then disappears again, so nothing's appeared. So we're going to have to probably close your bit in a moment, but Castle Trust are, for us, one of those lenders that you come across once in a while where the management and from director level down, you just develop a relationship with. And we've pretty much now got I don't want to say we got the ear, but I mean, I'm going to be talking about a couple of cases later on. We've got a lot of business pending with Castle Trust at the moment, quite a bit of offer. And it's actually been very refreshing to see how they're working at the moment, because it really is a positive way of working. So if it's a situation where something's maybe a little bit delayed, or all lenders are experiencing problems at the moment, I'm able to pick up the phone to Barry, the MD, and say, Barry, got this case, can you just have a word with somebody and maybe move it out of the pile of it? And so far it's worked. I mean, obviously he's not going to do that on every single case, I wouldn't expect him to, but it's just refreshing. You've got a lender where you've got the ear of everyone from the MD downwards. They've had a few additions in staff fairly recently of people that I've known for a very, very long time in the business. And that really has just enabled us to put business with them that we would probably struggle to get through elsewhere. So again, listen to my bit that's coming up in a bit, and you'll hear all about it. Gary, that's fabulous. That was actually Hikmet just saying thank you to all the speakers. So thank you, Hikmet. Okay, right, everyone. So Gary, I'll get Simon to remove you from the room. Don't do it yourself, otherwise you might not just close down your presentation, but the entire presentation. So there's a short pause now, everybody, because my IT department has asked me not to say anything for about 10 seconds whilst I put on my bit, and then I'm just going to talk for a little bit about us, what we can do, and a few other bits and pieces in the market at the moment. On to our bit. Now, 3 months ago, I started doing something that was for, I mean, we've done a lot of these basically shows over the last, well, since July 2020, during when I just started planning whilst lockdown was on. So the first one was in July 2020. We've done a hell of a lot of these now, and I always try and mix things up a little bit. So a couple of months ago, I decided to do this. What's happened in the last month? Well, guess what's happened in the last month, everybody? Lenders have increased their rates, some too frequently, way too frequently, and I think some of them are actually profiteering from what they're doing, because I've seen base rate trackers where the actual rate over base has increased significantly by 40% in some cases. And you think to yourself, well, why is that? What's the reason behind that? I've asked the question, not had the answer so far. So it'll be interesting when I do get an answer. Too many are increasing rates to reduce business levels. Well, I've got a very simple solution for any lender that's struggling with business levels at the moment. Get your staff that are working at home back in the office so they can communicate with their colleagues, rather than it taking 2, 3, 4 days for a call to be answered, an email to be answered, wherever else they communicate with each other. Let's get back to the way we were working before, when it was busy, you could at least cope. Because some lenders at the moment, I believe, are using it as an excuse. And it's getting beyond the pale. It's now getting to the stage where in the past couple of months, we've lost cases, purchase cases mainly, purely because the seller has withdrawn the property for sale because we've been waiting on an offer for 10 days, as an example. It tends to be the smaller deals, thankfully, rather than the bigger deals, but it's not good enough. Quite simply, just isn't good enough. A lack of experience within some lender underwriters is beginning to surface. Okay, hot off the press, we've been asked this morning by a lender. This is for a client who has his own limited company, and we provided SA 302s and tax year overviews, proving the tax has been repaid. And we've been asked, if he's self-employed, why has he got an employee income on the SA 302? We've waited 3 days to get that, and we've now answered it. And when I finish this today, I'm then going to be getting on the phone and saying to a director at that lender, if you think that is going to the back of the pile for another 3 days because your underwriter doesn't understand how self-employment works, you've got another thing coming. I'll take you off panel, because it really is getting beyond the joke. We've been asking them fairly recently questions such as, why hasn't this sole proprietor got a balance sheet on his accounts? Another one of my favourites, we cropped up during COVID, but actually has cropped up about 3 weeks ago again, is clients drawn money from his director's loan account. Why isn't the director's loan account shown on Equifax? Can we see a payment schedule? And is he up to date? It beggars belief. It really does. When it comes to self-employment, really, some lenders need to pull their finger out, because it is now getting beyond the joke. I'm now going to recommence doing a blog that I stopped doing many years ago. I think I stopped it about 6-7 years ago. I'm going to start it again. So if you see an email, the very first one I'm going to do, the very first blog I'm going to do is on lenders and their understanding of self-employment, because it is ridiculous. Lender staff, underwriters, believe it or not every person in the world is employed out on a PAYE. Others are self-employed and their income is derived differently. So please learn all the different ways that the borrowers may be paid and the reasons why they do it that way for tax purposes. That's why they employ an accountant. Very simple. I'll get off my soapbox now. Surveyors continuing in their aim to ensure as few deals as possible go through. Sometimes it just beggars belief what I see. When you get comparables and they're actually valuing a property 15-20% lower than the lowest comparable, with no justification whatsoever, other than the fact they want to protect their PI cover, probably because they went through the 2008 crash and almost lost their PI cover. And I'm talking about a couple of the really big surveyors here who we know undervalue every property. but it's still going on. And the last point, too many solicitors continue in their aim to screw as much cash as possible from their clients by giving the slowest possible service and asking for the stupidest things or questioning the stupidest things just so they can keep that clock ticking. So it's another 6 minutes they can charge their client, and another if they're charging £350 an hour, because they're probably thinking about their next summer holiday. Again, it's got to stop. Really has got to stop. And there is actually something we're now doing to get around this. As you probably understand, I'm quite angry about some of the stuff that's going on at the moment. So there's been a change in the way we work. So that's one of the changes to today's presentation, which you're going to find out in a minute. Okay, buy-to-let news. I'm only going to cover this last month because there's been no positive news this month. I'm just going to cover Quantum again. I know one of the people from Quantum is watching today. So recently launched, we've been granted packager status. Just a few bits on Quantum. They are presenting next month, so please come and join us and you can see what they've got to say. Just little things like deck access, flats accepted, no minimum income. There are lenders out there I know who will do both of those. Gifted deposits from any family member, second cousin twice removed, etc., etc. You can probably get the gist of what I'm saying, but gifted deposits from any family member. Day one remortgages accepted. Open banking, fine. No first. They won't do first-time landlords. That's pretty much any time they say no, which is the next slide. Look at the bottom one. Will lend on studio flats under 30 square metres. The lowest one so far, I'm told by their sales director, Spencer, who I've known for donkey's years, is 11 square metres. So just think, all the clients you might have turned down in the past because they've got a studio flat in central London that they can't raise cash on, or they've raised cash on a very, very expensive rate because there wasn't anything available. Get in contact with them, then give us a call. And this is something I took from one of their presentations because they do say no more than other lenders. So you can see no credit scoring, no ICR calculation on remortgages or pound for pound remortgages, no minimum time ownership, no minimum size, no maximum age, no restricted solicitors panel. So there's lots and lots of positives. So give us a call if you've got any cases that you're really struggling to place, because I don't want to say I can guarantee, because I can never guarantee anything. But for quite a few, we're going to be able to help. We really are. Another one that I've mentioned last month, this is Scroll Finance, lending on investment property. Talked about EPCs earlier on and what's going on. Well, here we have another lender that's come into the market. Rates have actually, I only spoke to their director last night, so forgive me, I've not updated that. It's now 4.94 as of late yesterday. Going up to 80% loan to value. All products are scored, but again, this is something, if you've got those clients who are in that 5-year fixed rate, 7-10-year fixed rate, high ERCs, you want to raise some money for them to get properties, that property or other properties in the portfolio up to standard, because otherwise I can see we don't know what the market's going to be like in 2025. Who knows what's around the corner? We could be heading with inflation the way it is, and I'm not an economist by any stretch of the means, but the way things are heading, are we going for another recession? I have no idea at all. It's not looking great. If you listen to the doom on the BBC News sometimes, we are heading for a recession as far as they're concerned. But it's probably the same people that have been saying since 2009 that base rates are about to increase. And then they kept saying it, and eventually they were right, but they were right 13 years later. But again, that's another lender that has just come to the market that's offering something that is unique, because it's also a drawdown facility. So you could have a client that can actually get a facility for, say, 200 grand and then draw down bits to do each property in their portfolio one at a time. So once again, it's a fantastic product. Keep it in the back of your mind for when those situations come up, because it can turn a no, a decline, into an acceptance very, very easily. So some information about us, what we can do for you. A lot of you have heard this before, probably many times. Quite simply, I see what we do with you as a partnership. It's about two entities trusting each other and also understanding the way that we have to work. So, I mean, I've had a broker complain recently that a valuation was taking too long. Well, that's purely because there's not enough valuers out there. There's not a lot we can do about that. Or a lender's turnaround time is 5 days. Well, that's actually pretty good in today's market. I know some lenders have got 15 working day turnarounds. So it's just about trusting us to do the job we're supposed to do, trusting us to actually pay you when we say we're going to pay you. But we trust you to give us the right information and not try and pull the wool over our eyes. Because we are very, very good at what we do. Sometimes we'll make mistakes. People make mistakes. It's a people business. But we are very, very good at what we do. My staff are incredibly experienced. My most experienced member of staff, 1995. My longest serving member of staff, 1997, with a break because I made her redundant in 2009. She then had a baby and came back. So I've got very, very experienced people working for me. We want to help you grow your business. I want you to be around if you're going to be around in 10 years' time, unless you want to retire. I want you to be doing this in 10 years' time. Two biggest problems I had in 2008 was lenders falling over and not lending. So a lack of lenders. Then also, all of a sudden, a lack of people that was actually placing business with me because they just left the market in droves and went and did something else. Doesn't matter what your FCA status is. If you're not authorised, we have to come to some form of special arrangement or try and sort you out because our PI cover doesn't cover applications now, regulated applications from non-authorised entities. So there is some things that we can do. There are some workarounds we've got, but we do have solutions. We want to make sure you stay informed and compliant. That's the reason why we give out free GDPR checklists. That's the reason why we distribute the excellent Shawbrook EPC guide. We want to make sure that you are writing business for as long as possible. And when a deal does come in, you think, oh, that's a bit specialist, you phone Specialist Hub. That's what we want you to do. Our products, very simple. I'm not going to read them all out. We don't do equity release. We do everything else that's secured on property. Simple as that. Service, either we package it and you give the advice, or you introduce it and we give the advice. You choose. You can mix and match. You don't have to have one or the other. You could package your buy-to-lets through us. You could then introduce your second charges. You could do it any way you want to, literally any way you want to. It's entirely up to you. Each deal, if you're going on holiday for 2 weeks, you think, I'm not going to have time to get this through. Normally you put deals through us and we package it on your behalf. We can then give the advice to your client. And why are we different? Not the products we offer exactly the same as everybody else. A few exceptions. We've got the occasional exclusive. I'm hoping for an exclusive from one lender fairly soon, which I'll be marketing the life out of, but let's wait and see. It's certainly, we offer exactly the same as everybody else. It's the people we employ. Minimum 5 years experience just to even get for an interview with me. I will not take people in. I'm not interested in taking people from university, college, school. You're not interested in phoning up my office and speaking to somebody who sounds like they just left kindergarten and speaks in tech speak. I'm not interested in speaking to people like that. I'm sure you're not. So you want to speak with people who are knowledgeable, know their stuff, and you can speak to them on an equal footing. And you know the answers they're going to give you are going to be the correct ones. Multilingual, this is very important. I've actually added one to this, which I can pronounce. I can't pronounce the first 1, 2, 3, 4, 5. I can pronounce Hebrew because I wasn't aware one of my members of staff has a smattering of Hebrew, which has come in very useful in a couple of cases recently that we've done for some Orthodox Jewish clients. Mature life experience. So that's the reason that's underlined is that's the most important thing. The most important thing is they got that life experience and they actually know how to talk to people, whether they're talking to you or if we're giving the advice, we're talking to your client. And I'll say your client because it is your client. So important. I can't stress that enough. So feedback given, I won't read all that out, but it's feedback from a guy who has completely actually introduced the deal, the first deal, one of the first deals I'm going to be talking about a little bit later. But just quite simply, he wishes that he had found us years ago because he's now semi-retired because he could have earned a fortune. His words, and that's what he's actually said to me over the phone. And I typed it down. He won't put it in writing, unfortunately. Just wants to give it to me verbally. But every month I have the same conversation with him. Absolutely raves about my staff and says, I've never found staff across the board that are as good as yours. And he's been in the market he's 70 now. He's been in the market for decades. Why are we different? Lender relationships. I've been doing this now for, can't believe it's 40 years next year, but almost 40 years. And because of that, I've grown up with a lot of people that started the industry as BDMs or office juniors who are now sitting at director level with their current employment. That's the situation I've got. So when we have a problem, like I mentioned before, we've had a lender come back with something absolutely stupid today. I will be speaking to somebody I've known for 3 decades at that lender and say to him on the terms that I can speak to him on because we've known each other so long, don't be so stupid. Put this case back to the top of the pile. It's not our fault because your underwriter doesn't know how self-employment works. And that is something you can't buy. You can't buy lender relationships, although some brokers do try. It's incredibly important. How seriously we take compliance, and we do take compliance incredibly seriously. NACFB now on 2 occasions, 2 compliance visits, still not had our 3rd one, which is due this year, said we are the best by a country mile. And we got that in writing. It's how serious we take the prevention of financial crime. 3 people we found during COVID trying to commit fraud, reported all 3 of them. Guess what? All 3 reported to action fraud, no further action. And it's not our numerous awards from the financial press. Now, there's a couple of new slides here, which I'm quite proud of, because I was on holiday last week and my wife had an upset stomach and we couldn't go out anywhere, so I was bored. So I did a little bit of work on my phone, and this is what I come up with, not the next slide, but the one afterwards. You've probably all seen this one before. This is one of my competitors who every time it's award season goes on Facebook, goes on Twitter, goes on Instagram, and gets all his mates to vote for him. And one of them, one lucky winner or lucky voter, will get a £250 Amazon voucher. Well, that shouldn't be the way it is. But this next 4 or 5 slides, I think, to me, sums it up. Now, I'm not going to actually express an opinion on this because I don't want to be sued. So I'm just reporting facts. That's all I'm doing on this. But this is what we had on the recent awards. Now, the main sponsor was HSBC. And as I say that, I am not alleging any wrongdoing has taken place for the benefit of the court. Okay, but main sponsor, HSBC. There you go. And announced towards the end of last month. These were the winners. As you can see, there was 20 categories, 20 winners, obviously, well, 19 winners, because actually HSBC won a couple. But so that was the winners. Okay, now I'm going to flick to the next one, then flick back to the first one, then flick back to the second one, just so you can see these were the sponsors, or the regular advertisers, heavy advertisers with that particular online publication. Just to click back. There you go. There's the winners. And there's the sponsors and regular advertisers. There would have been more, but not every award was sponsored. 3 of them weren't sponsored. So 15 of the 20 awards, that's 3/4, were won by companies that sponsored the awards or were major advertisers. Now, again, I'm not alleging any wrongdoing whatsoever because there was a judging panel. So you can take it as however you want to on this. Now, this was the other one. HSBC sponsored 2 categories, Best Surveyor and Best Network, and Central Trust sponsored Best Second Charge Broker. Central Trust, or a second charge lender, whose owner I know very, very well, and I consider him to be a very good friend of mine. Okay, so that was the situation with those 2. So HSBC, just watch that one, sponsored 2 categories and won BDM of the Year, probably one of the most prestigious as far as staff are concerned, Best Mortgage Lender, the most prestigious and the last award that was actually given out. So you can imagine that was the one everyone was waiting for. They won both of those. Obviously, they're a great lender. They've been my bank for 42 years, so they must be great. So that's what they won. Central Trust, the Best Second Charge Broker, was awarded to the Loans Engine, who are a subsidiary of Central Trust. Okay, I'll leave that there. You make up your own mind. Okay, what else we can offer? I'm glad I got that off my chest. Designate underwriters from start to finish. This is the bit that's changed, except now we have an experienced person, me, dealing with cases from pre-offer. That's for 2 reasons, because I'm sick to death of lenders saying, yeah, it's in the queue, we're waiting for offer, it's in the queue. Well, I've now got me to deal with, because I will be getting onto these, not the underwriters, getting onto the senior people within lenders and saying, why is it taking you so long to get my offer issued? That's the first thing I'm doing. Once the offer's been issued, I am then, because I'm sick to death of solicitors, I am absolutely sick to death of solicitors and the way they are acting. So I am now dealing with both sets of solicitors just to ensure that, for example, as recently happened, an email doesn't go into spam, so there's no contact made for a month on a deal. Absolutely ridiculous. So I will be dealing with both sets of solicitors, and I will ensure that deal goes through as quickly as possible. Guarantee it. Absolutely guarantee it. Commission is paid immediately on loan completion. That's the only other time I normally get involved on a deal, is when it comes to paying the commission. When it pays out, I pay you. As long as I've got your bank details. That's the one, obviously, caveat on that. I must have your bank details to pay you. And as long as HSBC's banking system doesn't go down like it did this morning, and I can't actually access the account, you will get paid the same day. Doesn't matter how long it takes to pay me or pay us, we will pay you the same day. And no commission clawbacks, unless it turns out to be fraud or the client cancels the deal within the contract period. That's the only time I've clawback commission. That's never happened. Something else we can offer, this is very important, because you probably all, when a deal comes in, ask your client to get a copy of their Experian or Equifax report so you can see what they've got outstanding. Well, because we're in the second charge market, we're able to access both Experian and Equifax immediately. which means we can get what the lender wants to see, the proposed lender wants to see, within probably 45 seconds of getting the client's authority. So we do a soft search right from the outset at our expense, because I don't want my staff spending hours and hours on the case to find out the client wasn't aware they've got 6 defaults registered 5 months ago, which we all know happens. So that's something we do right from the outset. That just ensures we go down in the right direction right from the start, rather than relying on the client to actually tell us the truth. And we all know clients lie sometimes. But it just cannot stress how much time that saves my underwriters, or loan partners as I like to call them. And something else we can offer, I really wasn't happy, this was going back a few years now, wasn't happy with the sourcing systems and what was available. Mortgages, residential mortgages, absolutely fine. The sort of like front end buy to let side, absolutely fine. But anything that was a little bit specialist, they were really, really awful. So what we decided to do in house is that we came up with loan quote, commercial quote, and bridge quote. Loan quote covers second charges and some of the specialist first charge lenders, and can quote literally within 45 seconds. Commercial quote covers all the specialist lenders that you would never see on Trigold, Mortgage Brain, or 27 Tech. So we can actually get quotes on those. And it's not just getting a quote, it's actually ensuring the deal fits as well. Subject obviously to blending criteria and the right type of property, that type of thing. But it ensures the deal fits. It fits on the rental income. It fits on loan to value. The rates are updated when they happen, when we can. It's a real struggle at the moment with the amount that's going on, but we are keeping this up to date as much as possible. But I know yesterday there was 4 lenders change rates yesterday afternoon, and they gave us 3 of them, gave us actually launching them this morning. So guess what I was doing last night? Bridge quote was the last one we brought out. That can quote on your bridging applications from a panel that you'll see in a moment, which is large, a very large panel. And that gives us the access. So we know when the deal comes in, yeah, they're the cheapest, but the client needs it in 2 weeks. They're the lender we should go to. And we know it qualifies because our system has worked out whether it's rolled up interest that's being done, retained interest, or monthly payments being made. Data security. After what happened in 2015, our system was really, really tight, even then. But now you'd have to be an employee to get into my system. So as long as one of my employees doesn't decide to download all my data, and guess what, we would find out if they did, because we've now got things in place, it's not going to happen. So any client details you give us is as safe as houses. And full training, if ever you want it. I'm probably going to take this bit out because no one's actually ever asked me for full training, either virtual or face-to-face. So, but it's there if you want it. So all you got to do is ask. Second charge panel, not going to go through all those. It's everybody. Quite simply, every second charge lender that's out there. So I've mentioned before, second charge market, I'm the second longest serving person within the second charge market, continuous, I'm told. And therefore, I'm well known throughout the second charge market. And of course, all those lenders are on our panel, and that is every lender in the marketplace. First charge panel on the regulated side. If you want to give the advice, and we package, we've got all of those. Please don't give us a deal this afternoon where you want us to package for the Nationwide Building Society, because we're not going to take it. And please don't try and give us a 60 grand deal that you know has been on your desk for 6 months, because there's no money in it for anybody. So it's pointless us doing it. So, but these are the ones we can package for. The main ones we package for, there you've got Family, Foundation, Together and Precise, as you can see. And Central and Norton, the 2 lenders that do some of the real quirky stuff. Specialist buy-to-let panel, not going to go into everybody. We do deal with the Virgin Money and the TMWs and the Birmingham Midshires of this world, but these are the ones we deal with, our specialist buy-to-let panel, which again covers pretty much every circumstance you can think of. And our specialist, I'm going to get a tissue because my nose has started to run. Hay fever's driving me mad, excuse me. Our specialist buy-to-let panel, if you want to give the advice, there you go. All those lenders, you can give the advice, and we will not have any customer contact. And with these lenders, if you want to use any of these lenders and you want to use a packager, rather than go to the ones that are out there, we do not charge any packager fees on these 9 lenders, upfront or on completion. And that will save your client this. So you can look at the ones that are mainly appear on the sourcing systems: 3MC, Dynamo Impact, TVMC, TFC. They want to start with a T, don't they? You see, they charge anything up to 299 quid. We don't charge anything at all. So the next time you come across one of those and you want to use a packager, remember us, please, because we're not going to be charging your client a bean. And my staff, I pretty much guarantee, are more experienced than anyone else that you'll be dealing with out there. Bridging panel, either advised or non-advised basis, because of the amount of business we do. We have a packager status with almost every bridging lender that we deal with now, which means we earn more than if you went direct. So we can pay you pretty much the same as if you did go direct. But you've got our expertise and obviously our contacts that can be used to get deals through quicker, and also just get deals through that sometimes underwriters just do not understand. And some of the real complex deals, it does pay to have somebody on the end of the phone at the lender and the end of the phone at the broker who understands how to get that type of deal through. So that's one of the advantages we give. And our commercial panel, pretty much everybody. I'll probably be taking Santander off soon because of some of the comments I've seen today from them nicking business. But let's wait and see. But we deal with everyone that's actually worth dealing with. We've got some private banks that we deal with as well, which I don't publicise, but we can go to should the need arise. If you want to advise on second charges, you can do so. Again, I won't go through each of those. We don't charge any packager fees on our second charges if you want to give the advice and we just package it. So none of this 4995 fees being charged and you get paid like 30% of it, any of that nonsense. That's not the case. If you want to give the advice and access every second charge lender, we will do the sourcing for you. We will instruct the valuations. We will write for consent and know exactly what to ask for. We do all that for you, and we do not charge any packager fees. Again, one of the things you can see in a moment is you can actually ask to see our commission guide. You can see exactly what we pay on second charges as well. And here it is, exactly that. So if you want to see our guide, our product commission and proc fees guide, just enter proc in the box below, and I will get that out to you this afternoon, or my team will get that out to you this afternoon, so you can see exactly what we pay you. Beware of the bandits out there. There's still a load. There's too many, really, but just beware that you are actually getting what you're due. 2018 roadshow, actually a physical roadshow at a hotel. A delegate came up to me at the end of it with a bundle of papers. Had a client that was being charged initially 30 grand fee. Deal could only go through Interbay. At the time, I believe we was one of their largest, and the broker, introduced the guy that I was talking to, had been told that Interbay didn't pay commission. Well, obviously they do. They pay 1.5% as a minimum. So he's getting 7 grand from the deal when the introducer, even after reducing his fee to 24.5 grand, was earning 45,500. So just be careful who you're dealing with. Few case studies. I'm just going to sail through the first couple because this is one that we did, I think it was about 6 odd weeks ago. Very difficult deal with Yorkshire Building Society Commercial Mortgages. Great company to have on panel because they do tend to be cheaper than a lot of the specialist lenders out there, but they are also very, very picky. So we got this one through 3.35 fixed for 5 years, and we had to overcome such hurdles as companies based in Guernsey. Also, ultimate beneficial owner was based in Panama. It was horrendous, but we got it through. And the introducer earned £12,187.50 on the day of completion. Another one, this is one that I was involved in last year purely because the guy designs kitchens and has got a kitchen shop, and I want to get my kitchen done soon. So he's promised me to do me a free design. I've still not gone back to him yet. But this was last year, a remortgage that we did through Octane Capital, who have a policy. Their rental income requirement is 100% rental income requirement. That's all they need. No 125, no 145, because they're not authorised, not governed by the PRA. They've actually come in at 100%, and their main business is done in and around London for the low yielding properties. So this went through 32.5 grand. We paid the introducer actually over 2 days because I can only do 20 grand a day. So another great deal that we got through. Last case study that I'm going to sail through is this one. This was done November 2021. We're now arranging the refinance on this. Was a 10-bed HMO, but had 20 beds in the property. There was lots of issues on it, including a neighbour stealing the property's electric supply for years. So I'm not quite sure how that was actually found by the surveyor. We did a 10-month bridge for 2,150, and so we're actually arranging the refinance now. It's now been converted into a 20-bed HMO, and the license application is almost through. Excuse me. Introducer was paid £21,050 day of completion. Right. So I mentioned earlier on about the difficult cases. This is by far the most difficult case I have ever had to deal with in my almost 40 years of doing it involved in specialist finance. So very wealthy, 82-year-old expat and his eldest son living in Israel since 2001. All good so far. Refinance of 19 properties, 2 of the properties have regulated tenants, not too much of a problem. Put it to Castle Trust. We did originally have it with another lender, but there was issues. It was offered, but there was issues quite simply because they wouldn't allow dual representation and they wouldn't allow any form of title insurance. And the biggest problem we had is that we came across the worst solicitor that I've ever come across in my life. Now, I'm not saying all of it, he was autobanned, because I'm not sure when he started acting for the client. But as an example, 5 properties had mortgages that should have been removed between 16 and 20 years ago, including 2 lenders that haven't been lending since the crash in 2008. The lease on 1 flat that should have actually been registered in 2006 had never been actually applied for. So it was only when I actually found it when I was doing some work one evening on the deal, and we found that that particular flat didn't have a lease. The registration was actually issued the next day, but was issued incorrectly because it was issued on 2006 rules rather than 2022 rules. So it was done wrong again. We was even offered property as security that had been sold in 2012 from the client's portfolio. So we've got this deal over, we put it to a lender and we're saying, these are all the properties. Yeah, great. We've even sent a valuer out and couldn't work out why the tenant wouldn't let them in. It was because our clients didn't own the property. It was an absolute shambles from start to finish. ASTs in the wrong name, ASTs that could not be located. So they didn't even have the AST for the client. Properties not insured. The list goes on. I've put more man hours into this deal than you would believe. It was, and like it says there, by far the most difficult case I've ever had to deal with. But the good thing is it completed on, where are we now? Tuesday. And the introducer partner, 45 grand. And do you know what his involvement was? He gave us a name and telephone number. He's earned 45 grand from it, which is exactly almost half. I've taken out a little bit of expenses for the amount of land registry searches we had to do and leases because the solicitor couldn't do it. £45,000 for name and telephone number. So there you go. Very proud of that one. It's taken up a lot of my time. My wife's also very glad it's gone because I was a right grumpy git sometimes when I was getting home from work. Completing today or tomorrow, again, Castle Trust. So this is the strength of our relationship with Castle Trust. A lord and lady, elderly lord and lady, refinance of properties in the same village. Quite a big refinance, as you can see. First came to us in the middle of COVID lockdown. They couldn't understand why we couldn't find a lender for them. As I explained to them, you're aged at the time 84 and 80, and we've got a COVID flying around at the moment, which is basically killing off a lot of people who are aged over 70 years old. So you can see the reason why lenders might be reluctant to lend to those who are of advanced years, but they still couldn't get it. Also didn't help that they had over the years been defrauded of large sums of money on numerous occasions. It says several, it was actually numerous occasions. So they didn't trust anyone at all. Anyone at all. This is the second most difficult case I've ever had to deal with. And I'm hoping that today or tomorrow, I'm going to be sending my introducer partner 30 grand on this. We reduced their fees on this. We reduced the amount we was going to earn with Castle Trust just to keep the deal going. He's getting 30 grand. We're getting 30 grand. He's happy. They're happy, hopefully. But yeah, a real tough one. But if it wasn't for Castle Trust and the way they operate, this would not have gone through. Absolutely no way at all. And it's not what you know, it's who you know. Now, a lot of you would have seen this one before. Husband and wife business, running 2 very profitable children's nurseries. Mr. Run the financial side, defrauded HMRC of £850,000, hadn't paid the tax and national insurance for donkey's years. It was only when one of the employees applied to HMRC for some information. They said, well, we haven't got any records of you. Well, I've been working there 19 years. No, you haven't. Oh, yes, I have. They've looked into it, found out what he'd done. Mr. was sentenced to 5 years in prison. Mrs. divorced him, knew nothing about it because he ran the financial side. She just looked after the kids. Proceeds of Crime Act charged from every single property that he had his name on, which was their marital home, both the business premises and some buy-to-lets. So you go to a lender and say, got this deal, we want to repay proceeds of Crime Act charge. Guess what their compliance departments were saying? Absolutely no way. Reputational risk, all the usual nonsense. So it came to us. We approached a number of lenders, including our friends at Together. And we contacted Together Money. My underwriter contacted them. It was declined by the compliance department. Deal came to me to sign off as a decline. And I thought, absolutely no way. And we're declining this. 50% loan to value. Business has got 300 grand in the bank. It's got profits as good as, it's got accounts as good as you'll ever see. It's not her fault. Her husband was a crook. Not her fault at all. So I thought, I'm going to make a phone call. I rang a directorate together, had a 10-minute conversation, and within 10 minutes of him going to the compliance department, there's a big difference between an underwriter going to the compliance department and they're trying to show how important they are, and a director going to a compliance department and they're thinking, we want to keep him happy. And he came back and said, yeah, we want to do this. And they did it. And we got all the proceeds of Crime Act charges removed, repaid. She kept her businesses. And she's just come back to us for her third remortgage since this went through. Introduced rent just under 12 grand under their completion. For a deal that she would have lost everything. Absolutely everything. So just goes to show, it's not what you know, it's who you know sometimes. And this is what he sent us. I'm not going to read all of this, but the service you and your team provided and continue to provide is second to none and well beating. Thank you. And that's one of thousands of testimonials we've got over the years that just say how good we are. So if cases you can't place or cases you want to place and you're wondering where to put them, leave your name in the type message box below. Type of inquiry will come back to you straight away. Decision in principle forms will be sent out to you this afternoon for all our products. Complete while those send it back to us. Go to our website, specialisthub.co.uk. You can submit inquiries online or give the team a call. They're waiting to speak to you. Simple as that. LinkedIn, you should have hopefully had a request from me on LinkedIn, unless your name's John Smith and we can't find you. So if your name is a common one and you're on LinkedIn, you've not had a request from me, please send one back to me and I will accept it straight away. If you're in financial services, that's what LinkedIn's for me. It's financial services contacts. So please, yeah, by all means, would love to link with you on LinkedIn. You can just keep up to date with what we're doing. It's 1 o'clock. I've got a couple of slides left, not very many at all. You will get one of these today. If you'd like what you heard today, you'll get one of these today by email. Just complete and return that to us. We don't need that to actually receive a deal. We need it to pay you. That's all we need it for. Before I can pay you commission, I must have a signed agency agreement and your bank details. But get that back to us as soon as possible. Next Specialist Mortgage Web Show, 4th of August. We have Interbay, Roma, Quantum, and United Trust Bank all speaking. And I believe next month is sponsored by Roma. Future shows, first Thursday of every month, except for September. I'm not sure why we haven't got one on the 1st of September, but it's the 8th. I think it might be because it was still within school holidays. So 8th of September, 6th of October, 3rd of November. You can attend as many as you want. We always try and get different lenders at the shows, talking about different products wherever possible. So there'll be something unique every single time. Feedback and CPD, this is important, people. So when you leave today's session, click the event board in the top right corner and then click the red exit event box, complete your feedback form, and your CPD certificate will be sent shortly afterwards. If you haven't got it by tomorrow afternoon, email me and I'll get the team. That 10% of them for some reason never seem to actually occur or happen. So just pop me an email and I'll get that sorted for. But the feedback form is very, very important for us, especially with 2 new speakers today. I want to see what you all thought of them. So let us know. And also help us out. We do these completely free of charge to delegates, also free of charge to lenders as well, because we can see the benefit that basically all of you will get from these. And the feedback we get from some of you is fantastic as to how much you enjoy them and how much benefit you get from them. So if you can leave us a review on Google, just type Google Review Specialist Hub or Trustpilot Specialist Hub, leave us a review on one or preferably both. Do not go to Specialists Hub, which is a training company, nothing to do with financial services. Otherwise, you're leaving a review for somebody you've never heard of before. But that'd be very, 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 very gratefully received if you can. Big thank you to today's sponsor, Hope Capital. We hope to again see you soon. And finally, enjoy the rest of your day. Until next month, stay safe, I'll speak, and prosperous. Thank you very much indeed.